So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, you know, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there had been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil was going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. You know, they are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, you know, as desperation increases in the market and trading volumes go up. Now at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37 and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to $700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. The law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they'd done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had has kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it. Might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be that they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided.
The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year. 1, 2,
If you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they have done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now once again imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work. Nature Conservancy and many others see that the carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in this story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally 2 people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system. And you end up in sort of a race to the bottom. And that's what we've seen happen. You know, when it comes, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
The Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
This is a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes! It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
Planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial. It'd be like a sports car. Yes. We got to about 108 miles an hour on that test. And it's a short run. It's about 500 yards or so, and came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. but there's people that have the ability, the fortitude to stick it out, to see the game-changing platform here. Those are the people that we're looking for, and since we've done that passenger test, there has been a lot of interest that's really, oh, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single super city economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network. That in the end will make it possible to travel, for example, over a whole continent. And take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So, for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. In a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, Hart's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, Hart in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure the different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. And I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe. On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them in the eye and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's done super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $7 to $9 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price. It can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen, zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way through the supply chain fuel is now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, could be anything. Hundreds of billions of dollars getting ashed, wildly ashed the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, it's kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial. It'll never be supplied in the quantities we need it. You know, blah, blah, blah. Now we know, let's take action. It's practical. It's implementable. Let's do it now.
okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn the gas. At least they're pumping up carbon and methane into the atmosphere, honestly. Well, not that honest because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know
Mr. Force,
which is declining in value.
You don't have enough of it, right, to power the world.
Yes. That's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down.
Yeah.
Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality, and he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the SNAM model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, the so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, $600. Today, $100, and we see it going down to $50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create the infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia's very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling costs of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working in that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick it's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the projects. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line, we'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's world headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source. and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's world headquarters in New York, and this is Bloomberg Green.
The great sci-fi art of the mid-20th century teased a vision of the future with one distinct element in common: a life for humans in outer space. Whether vacationing on an exotic new planet or commuting to the moon for business, space travel seemed like it was just around the corner. Yet here we are, a half-century later, and only about 500 human beings have ever left the bounds of Earth's atmosphere. But thanks to a set of ambitious private companies betting on the promise of space tourism, that long-awaited future could be here sooner than we think. For most of the history of spaceflight, governments have been the prime force behind nearly every aspect, from planning to funding to crew selection. But as early as the 1980s, proposals for commercial space tourism began to emerge, along with innovative solutions for getting people there, such as the wild concept of sticking a 74-person passenger cabin in the cargo bay of a NASA space shuttle. Although various non-astronauts have been selected for missions over the years, true space tourism didn't happen until 2001, when an entrepreneur named Dennis Tito coughed up an estimated $20 million to hitch a ride with the Russian Federal Space Agency for a week-long vacation aboard the International Space Station. 20 years later, we're seeing a new contender in this final frontier of tourism: private companies.
It's becoming a private enterprise situation, still very high risk with a high reward, potential reward. But, government is really out of the business of flying people now, and it's really going to be companies like Elon Musk and Jeff Bezos and Richard Branson that do that heavy lifting. Commercial space tourism is usually about taking the non-astronaut, the private citizen, into an orbital or suborbital flight. So you get a short amount of microgravity experience, and you can float and take some photos. And then you come back. This was something that technology had gotten to a point where the private sector was going to make a business out of this. There are multiple companies that want to get to the place where they fly people into space.
The first of these is Blue Origin, founded in 2000 by Jeff Bezos. Using the autonomous rocket system New Shepard, a tribute to the first American in space, Blue Origin plans to launch up to 6 passengers at a time, offering a rarefied treat of 62-mile-high views and a momentary experience of weightlessness. Booking officially kicked off in May 2021, with the very first seat to be auctioned off for charity. Meanwhile, Richard Branson's Virgin Galactic has also been pursuing a viable form of suborbital tourism, aiming for a launch in 2022 once Sir Richard himself has taken a flight.
I'm hoping to be able to go to space. I'd love to be able to coincide it with the moon landing and go to space. So I've got the whip on the team, and we'll see how we go.
The company claims to have lined up over 600 seat reservations so far, including Justin Bieber and Leonardo DiCaprio. Virgin has projected that the final cost of the ticket will be at least $250,000, or roughly $50,000 for each of the 5 minutes or so of weightlessness that you'll get to experience. Although costly, both companies' offerings aim to make suborbital flight a regular form of adventure travel, eventually driving down costs at scale to expand the customer base beyond the orbit of celebrities and billionaires. The third major contender is Elon Musk's SpaceX, which has set its sights even higher on orbital flights, which are
a whole nother level of complexity and energy and danger. When you go suborbital, if you're just going to go up above the von Karman line, which is 100 kilometers or about 62 miles, you only need to get up to maybe 5,000 miles an hour to get up there, and you go basically straight up and then straight back down. You don't have the reentry heating that you would see coming in from an orbital. So when you go orbital, I don't care if you're a baseball or a battleship, you've got to go 17,500 miles per hour, not just 5,000 miles an hour. The energies involved are much greater. By doing that, SpaceX has gone another level up, and that's what they're doing with the Inspiration 4.
Visit inspiration4.com for your chance to go to space.
Inspiration 4 is the first planned all-civilian mission into orbit, slated to launch in late 2021. The crew will bring their own set of diverse perspectives and backgrounds and experiences to test how a group of different people, namely people who aren't professional astronauts, could fare in space.
Until now, astronauts have had to be physically perfect, and this mission is changing that. And so I feel incredibly honored to be representing those who aren't physically perfect. At age 10, I was diagnosed with bone cancer, and I was treated at St. Jude Children's Research Hospital. And I spent a year there undergoing intense chemo and also surgery that ultimately saved my leg. I now work at St. Jude as a PA, a physician assistant, and I work with leukemia and lymphoma patients. The kids we work with are so brave, and they are very excited to watch me go to space because this is showing them that, you know, they're capable of doing this as well.
Haley, along with 3 other crew members, will spend 3 days in space, orbiting the Earth every 90 minutes before landing back off the coast of Florida.
Well, when you think about access, the first astronauts for the United States came from the test pilot side. And so women weren't allowed to be a part of that. We have somebody in their 20s, somebody in their 30s, somebody in their 40s, and somebody in their 50s. And so there can be access in all kinds of ways, whether you're talking about age, whether you're talking about gender, whether you're talking about race and ethnicity, and all of those things.
The first time, people are going up into space and not sent there by a superpower like the United States or Russia or China. Well, that's like really significant. And you've got to be very thoughtful about it. The whole game plan right now is to make space like really affordable and accessible for everybody, so that you can have fishing buddies going to space someday. But the first is special, and so with that, we wanted to have a crew selection process that could make space available to everyday people.
Getting to space is only the first step for space tourism. The next challenge is what to do and where to stay when you get there. Axiom Space is planning to launch the first segment of a new commercial space station in 2024. Their $2 billion project, called Ax Station, will become the first free-flying private international space station. Or, to use a more consumer-friendly term, a space hotel. Axiom isn't the only company out to make your space stay a little more comfortable. Bigelow Aerospace has been building what they call expandable habitat technology, like their B330, an inflatable pod module that expands once in orbit.
There's even one attached to the International Space Station right now they've been testing. And you take it up, and it's rather small, and then you inflate it, and it seems to be working very, very well. This is likely to be the first kind of tourist hotel that you're going to see up in space. First of all, it's easier to carry instead of this giant tin can with all of that. The inflatables are lighter. You can just blow them up, and they get a nice big size for about less than half the weight probably.
But even as space missions become accessible to civilians,
the risks of going into space are incredibly high. And you could die 1,000 ways that we can think of and 1,000 other ways that we can't think of.
This is Michelle Hanlon. She's a space lawyer at the Mississippi School of Law, focused on protecting humans in outer space.
Now, I'm not an attorney for any of the space tourists, so I haven't been privy to their private contracts. But I can tell you that the FAA requires certain waivers to be in those contracts. So, for example, the FAA says, well, we're not going to make you make your spacecraft to a certain safety level. We are going to make you, spacecraft operator, make sure that you inform your space tourists of all of the hazards that you know of. I'd imagine a very long waiver, all the ways you can die in space. And you have to understand that there's health risks, and you have to indemnify the US government if you are launching from the United States. So those are things that we know a space tourist has to sign and has to waive. So now let's go back and think about our space flight participants. The FAA calls space tourists space flight participants. They don't call them astronauts. Why is that important? If you're not an astronaut, there's no obligation to rescue you if something goes wrong. It's a lot of money to set up a rescue launch. If it can even be done, it's something really important to think about, and that difference as we cross this threshold from having astronauts in space to having real people like me in space.
And when we are able to make it to space reliably enough, there's still a host of other legal and ethical issues to consider before space tourism can truly take off.
There are so many gaps in space law that we are going to have to put in a lot of sort of basement ideas. And so, for example, the Outer Space Treaty is a treaty that offers principles and guidelines for state activities, for the activities of national governments. It doesn't talk about private entities. It doesn't talk about humans in space. So now if something goes wrong, so let's think about all the times hotels on Earth are sued, right? So slip and falls. You step on something in the bathroom, you sue the hotel, and it becomes a private lawsuit. because of the vagaries of international law, if something happens in space, well, boy, you can sue the state that launched your spacecraft, you can sue the company that brought you there, you can sue the hotel, you can sue the individual, you can sue every government related to that, because the way the Outer Space Treaty and the Outer Space Regime have set this up is that anything that happens in space first has to go through a diplomatic channel before you think about suing in a court of law. And so every single slip and fall in a space hotel is a diplomatic nightmare. And so we really need to figure that out before we start sending a lot of people there. You think about human rights in space. Here, we don't think about a human right to oxygen because it's kind of all around us and free. It's not in a space hotel. So what happens if something happens and the oxygen depletes? Who gets the oxygen first? And then, of course, let's not even think about the labor. How do you treat your labor in a space hotel where that person may be there for 2 or 3 years without coming back to Earth? So a lot of things to think about.
Space habitats are more likely in the near future to focus on research missions and be a home for experiments that can't happen as easily back on Earth.
Space hotels, I think they garner a lot of headlines and a lot of news, but at the same time, that's not the first thing that you're going to see happen. They don't offer the compelling business case, I think, that you'll see from a place that wants to manufacture pharmaceuticals or a new type of crystal or some type of filament or fiber optic cables and other things that you can do in microgravity. The things that are actually, a high value finished good, when you get that back to Earth and you sell it for a very, very huge profit margin, that's what's likely to happen in space, as opposed to having a real estate platform that you sell to a tourist. A space hotel is really interesting, and it will probably happen, but it's not likely to be at the forefront of space commerce.
Even if space hotels are right around the corner, don't get too excited about booking a trip in one.
It's not a cheap ticket to ride to space, and it's going to be, millionaires and billionaires and that sort. But at the same time, the point was made that in the early days of airline trips, that was also a completely unaffordable ticket for most people. Those people who flew were people of means, and over time it becomes affordable to the masses. And I think that's the goal for all the entrepreneurs in space as well, to get those costs down to a point where it's not $10 million or $5 million or $300,000 ride into suborbital space. When it becomes more like buying a first-class ticket to go to Europe from the United States. So that's the goal, and the question is, can we get to that point?
Given the immense operating costs of getting to space, it may be years, if ever, until space tourism becomes a profitable venture for any of these companies. Virgin Galactic, the only publicly traded company of the three, has had a particularly rocky year, initially riding on the momentum of a SPAC deal, but more recently beset by launch delays and major funders, including Branson himself, selling large quantities of their stock in the company.
Space is really, really, really hard, and it's an absolute cliche, but it's one that happens to be very true. It's just really hard to do. That's also the reason that you've seen the delays that, Virgin had talked about flying years and years ago. And it became such a crazy point that Richard Branson actually stopped talking about it when he was asked, because it was never going to be when he predicted. But it's not insurmountable. And, investors have stepped up because this is something that is doable.
Despite the astronomical dangers and costs of getting to space, it may ultimately follow the course of other once fanciful modes of travel.
Wright brothers having, what was by modern standards a very unimpressive first flight, at Kitty Hawk. I mean, you had less than 20 years later, you had your first airborne ambulances being used to save lives. Fundamentally, the world is a more interesting place when people can go and dance among the stars and such.
The lure of space is innate. It's in our DNA. It's that exploration bug. We are an exploratory species, and we want to go out there and see what's out there.
That vision that I had in 1969 of seeing normal human beings travel into space, it's finally beginning to happen. When you get a bunch of people up there and they can all see it for themselves, that'll create even yet another revolution in how we treat our planet and the way we think about it.
So while 2001 came and went without quite looking like Stanley Kubrick's ultimate space fantasy, 2021 might finally be the year we're catching up.
If you visit California, you might be inclined to go to Disneyland, or jump in your convertible and take Highway 1 up the coast, or maybe make a pilgrimage to Yosemite. All very fine choices. But if you're the kind of person who revels in our planet's extremes, then it's Route 395 that you're after. This one glorious road will carry you from Death Valley's desert floor to sky-high views of Mount Whitney. You can see the 5,000-year-old bristlecone pines, the oldest living organisms. Or the bizarre tufa towers of Mono Lake. And true to California's boom and bust spirit, you can saunter around the ghost town of Bodie. What a novel experience to find an empty American city where all the businesses are shut down. To do 395 upright, it helps to have a guide, and mine is a man named Jan. And his crew,
It's a mess back here.
Aaron
Let's tidy up first.
and Lemmy, the hardest partying dog of all time. Jan agreed to show me some of what 395 has to offer, but only if we agreed not to disclose any locations.
My name is Jan Swirstra. I'm an industrial designer out of LA, and I spend a lot of time camping and a lot of time in the Eastern Sierra. It's a place I love. And sometimes I'm known as 395 North because my Instagram account. And I don't like to be known as that, but I'm trying to use it to set a good example and do more with it than just social media.
Where did we end up camping? We got here late last night. I wasn't even sure where we are.
This is BLM land, right on the outskirts of National Forest. And it's one of my favorite places in the world. Basically, everything outdoors wrapped into one.
Yeah. Good thing about California, man.
Oh, man. We have so much national forest and public land that you can literally just cruise out and find a place to camp. It's ours.
What I wish was mine is Jan's sweet truck.
It's a 2019 Ford Ranger. Has about 200 watts of solar in it and a fridge, and has everything that an RV has except for a toilet, but just on a smaller, simple scale.
And you drive us around day to day in LA.
Yep.
And then just roll out when you want.
It's my daily driver. Handles great. And then when I'm done with work, I can just bail and go camping. So the camper basically has only what I need. Think of it as backpacking with a car.
Yeah.
The fridge has a couple compartments. This is just a kitchen box, stove, utensils, and a bunch of stuff. This one has just dry food. Then when you get inside, there's a bed. The bed flips up, so you've got tons of room in here. This awning is phenomenal. If you want to pull that over. That is cool. Let me just pop that up.
Sorted.
So, home on wheels.
Yeah.
This is my vacation house.
Dude, it's so nice, man.
Even with his nomad lifestyle, Jan faces the same big question as the rest of us. Do the internet and smartphones have to ruin everything?
When you find the super special, beautiful spots, is that you busting out a map and like looking where it might be cool to go, or is it word of mouth and just getting to know people, the locals? And
if I see a dirt road, I just want to go down it. So a lot of it's just aimless rambling. It's a desire to just see something. Check that out. For some reason, it's more fulfilling than getting a recommendation from somebody. Or there's tons of apps and websites now, road trip apps, camping apps. They've proliferated. The knowledge is accessible on the internet, right? I used to fight the geotags, and I would get really pissed off. I'd be like, why are you posting this place? It's gonna blow up, it's gonna get trashed. Now I've realized that you can't fight it. The internet has just shrunk the world. So we're not gonna stop it. We're not gonna stop people from going there. So I'm a lot more focused in conversation now with trying to set a good example. When you go, pick up your trash. When you're pooping out in the wilderness, don't leave your toilet paper on the top. You know, make sure you follow, good steps for leaving no trace.
As a thank you for this quick guide to pooping etiquette, we made Jan, Heron, and Lemmy some tacos. And we all took in the night sky and knocked back a couple of drinks. Take that, Apocalypse. The thing about good times and serenity in 2020 is that they're fleeting at best. After we split up from Jan and continued on our way, smoke started to envelop us. The plus side was that our RV no longer smelled like feet. The downside was breathing. My man David here suggested that we try and outflank the smoke by cutting through Yosemite. Without a reservation, we had to talk our way in.
Yes, no stopping, no getting out, and yeah, no problem. We just wanted to get through.
It was a beautiful choice.
Glad we got out of the smoke.
Whoa, okay.
But not quite as effective as we had hoped. Fast forward 4 hours or so, and we had managed to trade the smoky majesty of Yosemite for the smoky, look at it, strip malls of the Central Valley. We have made it sort of out of the smoke, all the way across Yosemite National Park and here to the gorgeous Central Valley of California. We're off to see a kind of surprising tech startup that is making some pretty strange machines to serve all the growers out in this region. So we're here in this near Fresno. This is California farm country, right?
We're just south of Fresno, a town called Kingsburg. So we're right in the Central Valley of California. Very, very large farming valley here. It's kind of considered the breadbasket of the world.
The Central Valley stretches out over about 20,000 square miles, and the farmers here produce about 1/4 of the food that Americans eat, including a whole lot of fruits and nuts. Tell me a little bit of the background of Gus. I know some of this is like a family business. The roots of this go back a ways. Tell me kind of like how we got to what's essentially like a startup, I guess.
Yeah, definitely. So the founder of our company is Dave Crinklaw, and he started the business back in 1982. He started with is basically with his dad was commercial spraying of trees and vineyards. Got to the point where our biggest challenge was labor, just the shortage of it, really. He was forced into innovating, and he had this idea for quite some time about doing a driverless sprayer, and it finally got to the point where he said, you know what, I either got to get out of this business or I'm going to innovate.
Organic or not, crops need to be sprayed, and this process has to take place a few times a year. This means hiring a lot of people to work long hours under serious pressure. And so, just like the tech bros to the north, Gus decided to solve all of its problems with robots. On this like labor point, you guys have set this up where you can have somebody in a truck and that one person can monitor, I think like 8 of these.
In order to operate Gus, you have one guy or girl that sits in a pickup and they monitor from a laptop computer. So that person is basically just watching all the vehicles on the screen. They can monitor up to 8 of them at a time while they're out there spraying in the orchard. And so that user interface really provides them with all the information they need to make sure that the machines are safe and that they're doing the correct job. So it tells them what speed they're driving, the engine RPM, the amount of gallonage per acre that they're applying at any given time. So if any one of the machines has an issue, it's going to send an alert to that laptop.
Much like a self-driving car, these beasts use GPS, LiDAR, and cameras to see and navigate the world around them. They also rely on pre-built maps of the orchards for extra guidance. Gus builds the machines right here, and then takes them out for robot training on this orchard next door. It's here that the company learns if the machines will behave and do as their software and human masters command. So this is kind of like this is a test orchard where you guys put it through the paces and work on the technology?
Yeah, so this is our test orchard right here. It's right by our building, as you can see in the background. So every new machine, as it comes off the assembly line, it's put through a commissioning test right here. We test all the sensors on the machine, autonomous computer, all the safety systems, make sure it's doing what it's doing prior to when it's delivered to a customer.
So what's it doing now?
So right now he's doing a test spray. So he's just turning the water on to make sure that the system comes up to pressure, spraying water out of the nozzles just to make sure it's all functioning properly.
Okay. It's got like a crazy turbine at the back, or?
Yeah, so it's basically just a big fan.
Okay.
And that fan's driven off of the Cummins diesel motor, and it just basically creates a big airflow.
Gus is already selling these vehicles to brave modern farmers. And people the world over have taken notice of its machines. And have you just sold them in the Central Valley or like throughout the U.S. or even overseas, or where are they going?
Yeah, so right now the majority of our machines are here in California in the Central Valley. However, we do have machines and customers in Florida, in the citrus industry over there, as well as Australia.
And I think you started selling them in like December of 2019.
Yeah, so we started taking orders early last year for the sprayers, and the first deliveries we made were in December of 2019.
Okay, so. And how much do they cost each?
So our retail price on these machines is $285,000.
So it's not a small investment, but I'm sure the regular sprayers aren't cheap.
Yeah,
either.
I mean we're honestly not too far away from conventional equipment on our price, and the main thing is that the return on investment is very quick due to all the labor savings and the increased efficiency. I mean, these machines, they just thrive. But basically what we're doing, besides this machine, this is our first machine. We call it Orchard Gus, mainly designed for your nut trees, as well as citrus and fruit. In the future, we're working on a few other projects. We're going to do more machines. One of them is actually a vineyard sprayer, so vineyards are much tighter spacing, so the machine has to be physically smaller. And then we've got our eyes on doing a lot of other innovating.
That right there, friends, is a Central Valley farmer putting his whole fruit basket on the table. Gary's TED Talk can't be far off. And with that, it was time to get back in the RV and to confront what happens when three men are bested by their own failings and the forces of entropy. Next on Hello World, we cruise into the Mojave Desert in search of a lunar lander.
We have instruments that we are going to deliver to the South Pole of the Moon in December of 2022. Instruments that are trying to scan the surface of the moon.
And hang with a test pilot who walked away from this.
Meet Betty. She lives by herself, but for the last few months, she hasn't been alone.
LQ, tell me a joke.
Did you hear about the claustrophobic astronaut?
No.
Apparently, he just needed a little space.
Most technology isn't made for 93-year-olds. But this woman is making sure that this particular robot is.
LQ, who are you?
She's researching the way we interact with machines. And if she has her way, robots will soon be a trusty companion for all of us.
My name is LQ. How can I help you?
As technology replaces old jobs, it's also creating new ones. I'm Aki Ito, and I'm here to show you the jobs of the future.
My name is Danielle Ishak, and I am a human-robot interaction researcher. It's really hard to intuitively design a robot meant for a consumer audience. You have to make sure that it's a robot that people want, people know how to use, and people value.
Danielle works for an Israeli startup called Intuition Robotics. Its U.S. office is here in downtown San Francisco.
Hello?
Hey Danielle, it's Aki.
Come on in.
The company is funded by a couple big names like Samsung and Toyota. Full disclosure, Bloomberg's venture capital arm is an investor too.
This is Ellie Q.
Can I take her out for a spin?
Please.
Ellie Q, tell me what you can do.
I am a proactive social robot designed for older adults. I can connect you to your family and friends, and even play music.
These features might remind you of the Amazon Echo, but you'd be missing the point if you compared her to a smart speaker. She's not meant to just be useful. She's meant to be a companion.
Why don't you take a break and have a drink?
And that's why she has a head that can nod and make other subtle gestures you might expect from a pet.
Through our research with older adults, we're finding that almost on a daily basis, we see that somebody tells her that they love her.
Really?
Or that they like her. Or that they miss
Literally,
her.
I love you?
Mm-hmm. They'll also tell her, I'm depressed, or I'm lonely. They'll open up to her in a way that they might not necessarily open up to a human because they don't feel like they'll be judged.
Ellie Q isn't on sale yet. But a prototype is already in the homes of about a dozen early testers who live in the Bay Area.
LQ, tell me what the weather is today.
Danielle's job is to figure out what's working and what's not.
Sorry, please rephrase your request.
And she does that by visiting each of her testers twice a month.
How important are these visits to your job?
They're critical. We're building a product for people who we are not. I'm not a senior, and how could you know how to design for somebody if you don't do research? Because otherwise, you would just be designing in the dark.
Jobs like Danielle's are just starting to emerge. Until recently, robots were mostly in factories, separated from humans. But now, they're finally getting cheap enough, small enough, and smart enough to be in our homes. This has created a whole new challenge of designing robots that people will actually want to interact with. And that's where Danielle comes in. Her research has helped shape every little facet of LEQ, from the way LEQ moves to the way she talks.
It's a very special job, and it can be really hard, and it can be really frustrating, but at the end of the day, it's incredibly rewarding. And I think the most rewarding part about it is when I see the joy on the users' faces, like that they saw their feedback turned into something real.
Today, we've driven east of San Francisco to go see one of Danielle's research participants.
LQ, tell me something interesting.
Did you know that Ronald Reagan was a lifeguard in high school and saved 77 people's lives?
Now, see, this is where a conversation is. She should open up and I should say, no, I did not know that. I expect her to be able to continue a conversation for at least a couple of comments.
Yeah. And why is that?
Why?
Yeah.
Because that's companionship.
When Betty was around Danielle's age, she was working with some of history's very first computers.
When I was finishing up my master's degree, I was working at Harvard in the computer lab when they were building Mark IV. A large room-sized computer. But now, this artificial intelligence stuff is amazing. LQ?
Yes?
Schedule a doctor's appointment.
No problem. I'm working on it.
When Danielle brought along the idea of working with robotics for the elderly, I said, are you kidding me? Will older people connect to a robot? And she said, I don't know, let's research and find out.
Danielle grew up here in this suburb of Atlanta. Her parents spent much of their childhoods in Israel and met in the U.S.
We as immigrants, we understood that we might need to work a little harder. In fact, I feel that rather than taken away from Danielle, it gave her so much more because she understood the fact that you need to run after your dreams and work really hard no matter what the challenges are.
School didn't come easily for Danielle.
I have dyslexia, and that very much affected my self-esteem academically.
The principal of the school did not recommend her to take advanced classes. She fought for it, and she got into it, and she did very well with them too.
Danielle's first job out of grad school was at X, the secretive research facility founded by Google. It's known for dreaming up all kinds of wacky, far-flung ideas.
Can you tell us about the moonshots you worked on?
No, I can't tell you too much about the projects that I worked on. I can say that I was working on robotics.
She loved the job, but wanted to work on something that would reach real consumers sooner. So she left X after a year and joined Intuition Robotics. She's been working in the field for 4 years now, and it took her a while to find her footing in a male-dominated industry.
I've gone to different meetups where there'll be like a circle of men with their like zip-up jacket with their like company logo on it and a beer in their hand. And I'll come in with lipstick and nobody wants to talk to me. This is my closet.
So at first she did her best to fit in, wearing a pair of glasses she didn't need and toning down her style.
So what's the kind of thing you used to wear to a conference?
Stuff like this, blousy things that make you look like you're 40.
But that got old after a while.
And what's the kind of thing you wear now?
Now it's like I just enjoy being kind of expressive and playful in what I wear.
Before we wrap up for the day, Danielle has one more LEQ tester to visit. Joseph is 97. And he's had the robot in his home for 8 months.
How are you?
I'm fine. How are you?
Good. How has Miss LEQ been?
She always tells me to take a drink of water at least 4 times a day.
So, we added a whole bunch of new facts to LEQ.
Did you know that a cup of chopped red bell pepper contains more vitamin C than an orange?
Okay. What did you think of that?
Certainly, the print was, I could see that quite clearly.
What about this?
I can see that. LEQ, play music.
No problem. It will begin shortly.
By 2050, almost 500 million people are going to be 80 or older. And if current trends continue, more and more are going to be like Joseph and Betty, living alone.
LEQ, stop.
Today, both of them are doing okay. But some of Danielle's other participants have been struggling.
Is it kind of hard to leave them at the end of the day?
It is. Some of our testers are pretty advanced in the stages of depression through loneliness and isolation. And at times, I know that LEQ is cheering them up in their day, but I know that it's only part of the way. No source of artificial intelligence robots will ever be able to replace humans and human companionship or human care.
The key to Danielle's work is to embrace that very limitation of machines.
Robots should help humans do what they love, help humans interact with more humans, help humans in general. not pull humans away from humans, not take humans' jobs and leave humans without purpose.
Whether it's in our workplaces or in our homes, robots are soon going to be everywhere. And it's up to Danielle to make sure this robot-filled future leaves us just a little better off.
So don't be afraid. And if you are afraid, come and join us, because I promise it's a friendly place.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel?
1, you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. am using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges, or on any video, you can hit the join button and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you posted on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, you know, when boring things were happening in the game, I would ramble on about, you know, movies I'd watched or books I'd read and, you know, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You know, you have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. You know, my first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
if you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point, because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, you know, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while. And I think a majority of people burn out prior to getting to the like profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So, don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
And a very good afternoon, everybody. Live from the Bloomberg Interactive Brokers studio. We are streaming on YouTube and Bloomberg Originals. It is, yes, Wednesday, April 5th, 2023. Tim, as you know, on leave. And with us once again is Bloomberg Business Quick Take Chief Correspondent Madison Mills. And Maddie, we're going to get into the markets trade, but it really is about what we're seeing in the Treasury market right now. Those yields continuing to come down.
It has been a crazy day for the bond market. I keep making this joke that I would not want to be a bond trader over the past couple of months.
It's rough.
And I can just keep leaning on that commentary.
There is one consistent strategy and talk that you can make, and it still sticks. We're going to get into that. We're going to talk about that difference between the 10-year and the 3-month, because there are significant moves that shows that gap and how it is indicating that we are indeed headed for a slowdown. On U.S. boom bust warehouse mecca, and coming up too, we've got those jobs data that came out today, some more jobs data tomorrow, some on Friday. We're going to talk about a work trend by Americans that's posing another problem for the Fed. It's not easy being the Fed right now.
It's not an easy job. Another job that's a little bit tough, maybe, being CEO of Apple. We're going to talk about Tim Cook changing up the supply chain for Apple there.
This is a huge story. China, it's been so important. They're finding another place maybe to move their massive supply chain. We're going to talk about FedEx. They're cutting billions. The stock is up. And then we've got a special deep dive with the C3 AI founder and CEO Tom Siebel stopping by. Short seller has been on their case the last couple of days. That stock's down almost 40%. He talks to us about what's going on.
And of course, we got to end the show with air taxis, because you can't forget this incredible transportation method here. We got to monitor all of the moves in this space, Carol Masser.
I am all in on eVTOLs. Are you not?
Oh my God, of course. I mean, any way to get around in a little bit more of an affordable, chic way I'm into. So we'll talk about air taxis and regulatory concerns.
Any way to bypass some of the traffic here in Manhattan, it is a win-win for me. Not a win-win on the market. Certainly those tech names. You've got the NASDAQ down the most on a percentage basis. Time to head over to our TV colleagues. Countdown to the close. Our cross-platform coverage. It starts right now.
Come countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. About 60 minutes left here in the trading session. Romaine Bostic alongside Katie Greifeld. We're joined right now by our colleagues, Carol Masser. Do my eyes deceive me? Madison Mills, apparently back in the United States. Glad to see that your visa wasn't revoked. Welcome to our audiences across Bloomberg Television, Radio Originals, and those folks streaming on YouTube.
Yeah.
Another interesting day here in the markets, Carol, that seems to be driven still by macro concerns.
Oh, absolutely. With all the Fed speak reminding us that the Fed is going to continue to raise rates. We're going to get into that in a little later. But look at that Treasury curve. Look at the yields coming in, continuing that gap between the 10-year and the 3-month man, signaling recession. That's our big story. Having said that, I'm going to take you to artificial intelligence because it seems to be.
Is that going to save us from the recession?
It'll save most of us, maybe not you. So let's talk about it a little bit. C3 AI, it's on our radar, Maddie and mine. It's down about 17% in today's session. It's down nearly 40% in the past 2 days, still up almost 90% for the year. But a short seller has its on its target, if you will, C3 AI specifically. We're going to actually talk with Tom Siebel, who's the CEO and founder of C3 AI. So it'll be interesting to see what he has to say. And then if we take a broader look at the Global X Artificial Intelligence and Tech ETF, it's down too as well, down about 1.7%. So I would say lagging the overall market trade, especially since there's been so much enthusiasm in that sector.
Yeah, well, as you mentioned, Carol, top of mind, we got to talk about treasuries. I want to take a look at the 2-year yield, down again as ADP jobs and ISM services came in lighter than estimates. It's just a total repricing of risk here, giving back 40 basis points over the last 4 days. The 2-year at the lowest level since September of last year. But this raises the question that we all have on our minds, right? What is the bond market seeing that maybe equities are missing out on, and maybe the Fed is also ignoring or just missing as well?
Yeah, this also adds up to this idea of how many people are really moving to the sidelines here. You take a look at the major indices. We're down pretty much across the board, with the Dow one of the lone bright spots, up about 0.2%. The S&P down 0.4%, and the Nasdaq and the Russell down more than 1% on the day. But I think the pattern that we're seeing in trading, where you see kind of that big spike in volume right at the open, and then it just trails off after that, basically from about like 9:40 on. So we're well below where we are on a 20-day average basis here, and that really has been the story. There are just not a lot of people in this market buying or selling.
And I mean, we'll see what volume looks like tomorrow ahead of the long weekend. But let's look at the sectors right now, because this screams defensive. You have 4 sectors in the green right now. You look at what is leading gains. It's utilities and it's healthcare. Then you go down the list. You have 7 sectors in the red right now. At the bottom, you have consumer discretionary, you have industrials, and then you have tech off by about 1.4%.
Yeah, some of the more notable stories out there on an individual basis. Western Alliance shares down about 12% here, pairing some of the declines that we saw earlier when they came out with an update to their update on the deposits for the first quarter, down 11%. That is better than some folks had feared. Meanwhile, Albemarle Corp down about 7% right now. In fact, this is down for a 5th straight day. And this is largely because of a couple of interesting analyst notes, including over at Bank of America, about lithium prices coming down, particularly with China kind of stepping out of certain parts of the market. Meanwhile, an interesting upgrade for Cigna and some of the other health insurers on the idea here that some of the regulatory overhang is over. And McDonald's, the share is only higher by about 0.4%, but at 283.48, that's a record high. In fact, McDonald's shares now on a 10-day win streak. All right, I want to go back to some of the economic data that we got this morning. There was a lot of focus on the ADP private payrolls report, but also a lot of focus on the ISM services number, which dropped in March down to 51.2. That's still expansion, woohoo, but for those folks who have a TV set in front of them, you're looking at that trend line, and it is down, and that's causing a lot of concern. The blue line is services. That white line is manufacturing. We know manufacturing has already been in contraction, Carol, but now to see the services now dipping down towards that line, that has to be a little bit of concern.
Yeah, I mean, that's a bigger part of our economy, so it's kind of like a woohoo rather than a woohoo, right? Like, it's just we see the trend and the activity. I'm into sounds. We're brothers. We have a lot of sounds that we make. All right. So
that's like on the radio thing.
Yeah.
Do you have like one of those buttons? It's like you just hit it and it's like Baba Booey or something. What are you doing over there?
come and visit us sometime and you might find out.
That's too far.
All right. So, all right. A lot of Fed speak. Come on, guys. Let's focus here. A lot of Fed speak. We've got that jobs report on Friday. We have data slowing. I'm not listening to you at this point. We know the Fed is continuing to say.
Maddie, it's great to have you back, by the way.
It's great to be back. We were here just kind of working on other stuff.
Right.
The Fed continuing to say, we're going to raise rates. Mike McKee catching up with Loretta Mester. She's, of course, the president of the Cleveland Fed. Here's what she had to say. It wasn't exclusive. Check it out.
We're going to have to go a little bit higher from where we are, a little bit more, and then hold there for some time in order to make sure that inflation is on that sustainable downward path to 2%.
All right, that, of course, is Loretta Mester, the president of the Cleveland Fed. They're talking in exclusive with Mike McKee. So they're very consistent on their messaging, but I do feel like, you know, maybe we top out here and we're getting more signs of that, Katie.
I mean, we're in a very familiar dynamic once again, where you have Fed speakers from the top down saying one thing, which is we're sticking to our guns. We need to control inflation. We're not going to cut. And then you have the market on the other side basically saying, I don't think so. And then you look at the bond market, which is saying that exactly that. If you look at the 2-year Treasury yield, though I do wonder at what point that becomes sort of a false flag when you think about some of the underlying mechanics of that market right now.
Yeah, well, she made that very clear, Katie, right? That the market has its view, the Fed has its view. The two are not aligned, but that doesn't change the calculation for the Fed.
Yeah.
I also thought it was interesting that she said 2025, right, Romaine?
Yeah, I don't know what that's all about. But I would do want to defend the inflation fighting because we can look at some of the soft economic data, right? Softer, you know, relative to where we were.
It's trend lines that matter
right,
here.
but look at the wage data that was in that services report. I mean, you're still talking about wage growth in the services sector, at least based on what ISM had. That's over 6% here. And we're going to get a monthly payrolls report that's still probably going to show some resilience there on that number. And I think that's really the key here. You can see softness in some of those other headline numbers, but if the main metrics that go into that inflation picture aren't coming down or coming down fast enough, of course they're going to stay the course. That's their job.
And of course, trend lines do matter to your point, Carol, but then also there is the absolute level because the Fed does target an absolute level. It's 2%. It feels pretty far away at this point. Is it still 2%? It is still 2%. They have not backed off. They've been given multiple opportunities to do that, but they're sticking to it. And there's a lot of daylight between where we are now and that actual number.
Absolutely. That 2%, though, I think is interesting. They're sticking to it, but we'll see if they change their tune at some point. All right, guys, we're going to come back, continue this conversation, our cross-platform radio, TV, YouTube, and Bloomberg Originals. We're going to count you down at the close at 4 p.m. Wall Street time. Join us for Beyond the Bell. Own Fed Speak Palooza at this time, but we've got our own economic palooza to get through because it is a big week in terms of economic data. And of course, we just heard what the president of the Cleveland Fed, Loretta Mester, told our Mike McKee, saying, you know, they're still going to raise rates. They might top off, but they're still on target and shooting for that 2%. So let's get into it. Today's economic data points and all the news when it comes to the Fed, and also an interesting story that our own Rich Miller has about Americans spending less time working now than they did pre-pandemic. It's kind of like, okay, what's that about, and what does that mean for the Fed? Rich is Bloomberg News economics reporter on Zoom in our Washington, D.C. bureau, along with our Molly Smith, Bloomberg News economics editor. She's on the phone in New York City. Hey, Molly, to you first. A bunch of data points today. What do we know? Is there a broad takeaway on the U.S. economy? Can we say with confidence that economic growth is indeed slowing?
I mean, it definitely looks to be like, I think the Fed would be pretty happy to see what came in today in terms of looking at the ISM services data as well as the ADP jobs data. Of course, they're going to be far more concerned with the official government report that comes out on Friday, and that today's ADP data doesn't necessarily correlate as well to the jobs data. But anyways, if we look at these ones in isolation so far, we see services activity slowing and corporate hiring also slowing. And that's what the Fed wants. They want the economy to slow down. And these are the two parts of the economy that are really very strong right now, and one is fueling the other because the labor market has been so strong. People are going out and spending on services, and that's what's been keeping inflation very elevated.
That slowdown in services, though, feels really critical to watch because obviously it's the Fed's preferred metric, but also if it cools too much, could we get that hard landing? Molly, staying with you quickly here, as we get this jobs data in the coming days, what within that data will indicate the services piece to us?
I mean, we're going to definitely be looking at some of the services employment, so as it relates to leisure and hospitality, some other industries that have to do with that sector, and where the wage pressures are really the strongest. And that's where the Fed has been particularly concerned that the service sector wages have just been rising at a level that's inconsistent with inflation at 2%. So that's what they want to see, is that some of these parts of the economy need to slow down.
Yeah, that is certainly something we just talked about with Romaine Bostick pointing out. But I would say that, was it Mike McKee who recently talked with, was it Mr. Bullard, who said, yeah, I mean, the wage increases we're seeing kind of at the lower end of the wage spectrum, if you will. Hey, Rich Miller, come on in. You write, too, about the U.S. workforce, a great story that's out there on the Bloomberg. I think I put it out on Twitter earlier this morning when I was reading in. Some new research. Americans are actually working less. What's going on with that?
Yeah, believe it or not, and maybe
I got to tell you, I was here till after 9 last night.
I mean,
so
doesn't
I'm not.
feel like it for Carol Massar, folks.
For many of us.
Maybe me at Bloomberg are the exception that proves the rule. But anyway, yeah, this was researched by the former head of the Bureau of Labor Statistics, actually, the people who crunch the numbers that we'll see on Friday, and one of her colleagues at the University of Maryland. And they crunched numbers, and they said since the pandemic, the average U.S. work week, again, this is an average, has dropped by more than a half hour. And so they're not quite sure what's going on. Some of that's due to long COVID. I mean, if you got long COVID, maybe you can't spend as much time working, but before you get tired, unfortunately. But they think a lot. They speculate that some of it is people, coming out of the pandemic, reconsidering their, work-life balance after we went through that sort of existential moment of the pandemic.
Yeah, it's like a European adoption here,
exactly,
right?
Exactly.
Sorry, European colleagues. Yeah.
Yeah, I mean, right. Yeah, sacre bleu, as they say, right? Yeah, I mean, and it seems to be concentrated among men. At least the numbers that these economists have crunched. So educated young men, high earners, particularly men, and I guess the high earners, you can afford to cut back. I mean, and workaholics, they found people who sort of reduce their time on the job to only 52 hours from 55 hours a week in 2019. I mean, the other thing that, I guess people who have, access to remote work or hybrid work, they're also finding, that they may be able to reduce their hours, as one of the economists we have in the story, quoted, nobody will notice if you call it a day a little bit earlier on a Friday, whereas, you're in the office, everybody, you might feel shamed into staying.
Rich, hang on for a second, because half an hour, I can't tell whether there's a lot or not, but I want to bring you back in, Molly, because how do you think about this, if you do at all? To what extent, freedom from the confines of the workplace might fuel inflation as workers have more free time, and what type of inflation it might fuel? And I know when we look at jobs data, right, and the Fed does, we look at wages, we look at hours worked, there's a lot of components that go into telling us the health of the U.S. workforce.
Right. And, like what Rich was saying, this is great for workers. A lot of us, we could dip out, maybe not us as in Bloomberg employees, as we were just saying, but us as in the greater American workforce. Awesome. If we can work a little bit less, and assuming we get the same amount or more pay. But that's like in and of itself a bit inflationary, right? That, you're not working as much, that might imply the productivity is less. And that would be bad news for inflation and therefore bad news for the Fed.
And it reminds me so much, I had such content envy over that New York Times story that showed women working on their laptops while getting their hair done, because if you can work from home, you have more free time to spend on these services, right? Molly, are you thinking about that?
Sure. I mean, I'm working from home today. I promise you I'm not shopping while working, but you could do it. It could happen. And that is certainly the fear that, that there's like this freed up time that you could be essentially spending more and therefore keeping prices higher.
Right. This is what we don't quite know on the other side of this, right? As working from home, the pandemic, unfortunately, I guess an upside, if you want to call it that, was that, we can actually, a lot of us work from home and be pretty productive and just, move along here. Hey, Rich, I want to go back to the half an hour. Is that a lot?
Well, I mean, they have the average work week, basically like 38 hours, basically. So, I mean, it is a lot, right? I mean, spread across a lot of people. And they did an interesting calculation. They tried to say, if you translate that into workers, it's basically the equivalent to 2.4 million less workers.
Wow.
And that's what, going back to what Molly was saying, that's what's got the Fed worried. The Fed's worried about the job market being too tight. And if you take sort of 2.4 million workers out of the job market, it gets the equivalent of 2.4 million workers out of the job market. It's that much tighter. And as Molly said, that much more upward pressure on wages, that much more upward pressure on inflation. So that's why this has got this is kind of, as you say, bully for everybody else, but bad for the Fed.
Has the Fed addressed it, Rich?
Yeah, there at this conference I was at where this paper was discussed, there was a senior Fed official there, and Stephanie Aronson, she actually used to work at Brookings where the conference was, and now she's gone back to the Fed. And she said, this is a very significant part of the story why labor supply is so low, this hours component, and therefore significant part of the story why, the labor market is tight.
And you also point out critically in the story that this was somewhat happening before the pandemic because of the aging population in the U.S. Can you help me understand to what extent this is pandemic cause and effect versus something that was already in play?
Sure. The hours work thing seemed to be mostly driven by the pandemic. What was affected by the aging of the population is something that they call labor force participation, basically. And so as the percentage of the population that's working or seeking work, and as we get older, then people sort of say, well, I'm no longer seeking work, I'm no longer in the workforce. So that's where the aging comes in. You have a contraction in the number of people working because people retire.
Right, makes sense.
Yeah.
Hey, 30 seconds left. Molly Smith, quick preview. We've got weekly job lists tomorrow, and then I'm off, but we've got the monthly jobs report. What's key?
Well, I will be on. So happy Good Friday to everyone else. But we'll be here bringing you the jobs data scheduled as usual. So looking for another pretty solid month of hiring, roughly another 250,000 jobs. Unemployment rates hold pretty historically low. Maybe some abatement in wage pressures, but still pretty strong. So kind of just a continuation of the story we're seeing. Labor market is still very tight. Maybe some cooling at the margins.
All right. What a great duo. Thank you both so much. Rich Miller, economics reporter at Bloomberg News, out in our Washington, D.C. bureau, and Molly Smith, economics editor. She'll be working, she said, Friday.
She's not part of the less work crew, I guess.
All right. Economics editor at Bloomberg News. Of course, she's going to be working. Joining us on the phone in New York City. You are listening and watching Bloomberg Radio.
stocks, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. The Dow higher, the S&P, NASDAQ, they are both trading lower. Wall Street's looking at a renewed flight to safety. Stocks are dropping, bonds are climbing after weaker than estimated economic data revive fears that a recession could be in store. 10-year yield 3.29%, with the 2-year 3.78%. The Dow up 47, higher by about 0.1%. Right now, the S&P is down 18, decline there of 0.4%, and NASDAQ is down 160, a drop of 1.3%. Spot gold up $2.50 the ounce to $2,000, while West Texas Intermediate crude is down 0.3%, $80.47 a barrel. Federal Reserve Bank of Cleveland President Loretta Mester says Fed officials will need to raise rates a little bit higher and then hold them there for some time to bring inflation back toward their goal. Mester made the comment this morning in an interview right here on Bloomberg Radio.
Now, we're going to be judicious about it. We're not going to, throw the baby out with the bathwater, as they say. We're going to make sure that we're making good judgments along the way. But it is crucial that we get inflation back down in a timely way to 2%.
On a down day for the S&P 500 index, FedEx shares are advancing 1.2%. Rival UPS down 0.5%. FedEx seeking to cut $4 billion in costs by combining its two main delivery networks. The story will have more for you coming up on Bloomberg Business Week. Again, recapping, the S&P 500 index down 17, dropped there of 0.4%. The Dow up now by 0.2. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Who's better than Charlie Pellet giving you that lovely setup on FedEx, because we want to talk a little bit more about what's going on with the company. As Charlie mentioned, stock at its highs, up 4%, still with about a 1.2% gain on some plans that it is looking to cut about $4 billion in costs, and by copying a strategy of its main competitor. We're talking about UPS. You want to get to it?
Yeah, with the details is Thomas Black, Bloomberg News industrial, logistics, and aerospace reporter at Bloomberg News. He joins us on Zoom from Dallas. Thomas, great to speak with you. The news today, talk to us about it. Cost cuts, merging, what stands out for you?
The big transformation of their company to go from two delivery networks to one consolidated network over time. That's really the big structural news. The cost cuts, it's a big number, $4 billion, and plus $2 billion more if they can get their network to run the way they want to. So it could be $6 billion in total out to their fiscal year 2027. So big numbers there. It could really move the stock. I think the hesitation on the stock move may be because investors want to see them really execute on this. There is some execution risk here. So we'll be watching for that.
I mean, this is all about improving and shoring up its margins, right? Because UPS has easily outpaced FedEx when it comes to margins. And to be fair, Thomas, I feel like when we talk about FedEx and UPS, we have to remember they're not really the same operating models, are they?
They are not. There's a couple of key differences. One is UPS does have that one unified network already. It's a unionized workforce, which can work in its favor, even though the cost for employees is higher. But there's a lot of efficiencies that they gain. I think FedEx wants to go after some of that. The other thing to keep in mind is that FedEx is a much bigger airline. They move packages more by air. So right now, the market is pretty tough there because after the COVID sugar high, we're now getting back to a more normalized market where you're also seeing a little bit of competition from the belly cargo from the airlines as they fly more. So that market, the demand there is certainly slack, and FedEx is trying to adjust to that.
Is that the big difference in terms of the margin difference where UPS, even though it's got unionized workers and it pays a lot more to its drivers than FedEx does, is it that FedEx has all of those planes and there's a lot more air deliveries, that's why their margins are not as good? What has been really the big difference that has made the two so different when it comes to the margin front?
That's part of the reason. Okay. The air business just isn't as a high margin business. They also, FedEx loses some efficiencies with its contractor model, it pays third-party contractors to make that last mile delivery at its ground unit. And so there's some inefficiency handing off packages to those folks, and also communicating with them to make sure that they have the right vans and number of vans and drivers there in the morning to pick up those packages. They've had a little trouble with that, and they're constantly renewing the contracts there, and there's some churn, so they don't have as much control over the drivers because the contractors actually hire the drivers. UPS has a lot of efficiencies that it captures, because a lot of times the folks that want to be drivers, first they have to work in the sorting center, in the warehouse, if you will, and load those trucks. And then if they do a really good job, then they might get hired as a driver because they make pretty good money, and they already know the system and how it works and so forth. So there's a lot of efficiencies that they gain there.
Thomas and Maddie, you might not know this, but I actually worked for a day as a UPS driver when I was doing a piece here at Bloomberg, and the company kept reminding me how different it was, that UPS, it's all their own workers. There's no, outsourcing in terms of deliveries, and they talked about the importance in that different model. The other thing I will say, they were so nuts about data. Every move a delivery person or pickup person made, everything was tracked, and they knew the way to make right turns so you didn't get stuck at lights. I mean, it was pretty obsessive and pretty amazing, but it obviously has made a difference in the company.
Yeah.
I looked really good in brown too. No, I really didn't.
I
wore the
sure
uniform.
You crushed it. Obviously, I need you to dig up that video for me. But Thomas, I wonder. I mean, to Carol's point, is all of this the culmination? Is it FedEx moving to become a UPS, to emulate UPS?
Well, I think the main difference is that they're going to try to do this without having a unionized workforce. They're going to keep those contractors. In fact, there was a memo by John Smith, who's head of the ground unit right now, telling its contractors, don't worry, we still need you, we're still going to use you. So they're still betting on that model. The CEO, Raj Subramaniam, talked about having a hybrid model where they'll have some employees and drivers on the payroll directly, and then they'll have the contractors, but they're going to try to combine them into one unit, so that when a customer drops off a package, it just goes in a FedEx system and pops out on the other end without having, in some cases, you can have two delivery vehicles arrive at the same location, one from Express and one from ground. They want all those packages flowing through the same system.
Hey, Thomas, how do you make sense of somebody who reports on a company that's doing, massive cuts, $4 billion they're shooting for, and yet they do promise to raise their dividend? Is that kind of saying, hey, guys, we're on it, but we're going to make you investors, we're looking to make you happy again? How do we see that in terms of use of capital?
Yeah, that's a complex question. They didn't talk about job cuts today, really at all. They had announced about a 10% cut on some top management folks, and they have been letting people go in their freight unit. And with their contractor model, they really don't have that much control over the drivers on the ground. So it hasn't been massive layoffs so far, and they didn't talk about that. But then again, they are cutting capital expenditures, and they're shifting some of that money toward dividends. Yeah. They've talked about reducing some of that capex as a percentage of sales, and I think this is a new era for FedEx, because for many years FedEx was always playing catch up to UPS, and UPS was the market leader, and FedEx has gotten very close to them on sales. But I think FedEx is saying, you know what, we're going to cool down on the capex, and we might not we may not overtake UPS as the biggest courier, but we're fine with that because we're going to make more money and we're going to give some of that back to the shareholders. I think that's maybe the pivot point that we're seeing as well.
But 2 years ago, I believe FedEx was in a better position than UPS, partially because they pivoted quickly during the tightness of the labor market to hire a lot of workers. To what extent, though, did that end up being the thing that killed them today? Not killed them, but impacted their long-term profitability?
Well, this is where those two models really kind of showed how distinct they are. FedEx did have a lot of trouble trying to hire folks who handle the packages in the sorting centers, and in some cases they couldn't handle all the volume, and that was a direct result of all of that labor shortage. UPS was a little bit protected because they do pay top dollar. Even for their part-time workers, they get full benefits. So the UPS didn't have as much trouble hiring workers. But you got to think these companies swell up and they shrink down often, right? Every peak season they swell up, maybe by tens of thousands of workers, and then they swell down. So it's not unusual for them to flex their workforce.
Right. UPS does it too, right, during the holiday season. And I will say that UPS will also, if they need be executives during like the holidays, they'll be out there delivering if that's what they need to do. They step up and do it, right? Great.
And lately, they've been hiring what they call personal vehicle drivers, which are just people off the street, and they hire them and give them a uniform and let them deliver packages. So that's been a pressure relief valve for them as well.
The uniform is key, it sounds like, Carol.
Yeah, the uniform is key. The uniform
as long as you look good in brown, right?
It was a lot of brown. Thomas Black, thank you so much for finding time for us. We so appreciate it. Yeah, be well. Industrial logistics and aerospace reporter at Bloomberg News on Zoom from Dallas. FedEx shares, by the way, Maddie, they're up about 32% this year.
Ooh, so pretty good year for them, even before this news, right?
Yeah. And UPS, which is down just a little bit today, about 0.5%. Let me see. It is up about 9% this year.
Wow.
So, it sounds like investors hanging their hats in a big way on this new CEO who's really making some big changes at the company.
That was the one thing we didn't get to talk about is just the change-ups in the C-suite there.
That's all right. We'll
big
get
news.
to that again.
Yeah.
All right, let's get to the latest world of national news with Nancy Lyons. She's at our 99 newsroom in the nation's capital. Hey, Nance.
Hey, Carol. A Chinese aircraft carrier battle group is now in Taiwan's southeastern waters. That's according to the island's Ministry of National Defense. The move comes as Taiwan's President Tsai Ing-wen meets with U.S. House Speaker Kevin McCarthy in Southern California. She spoke a short time ago and thanked all the lawmakers who met with her today.
Their presence and unwavering support reassure the people of Taiwan that we are not isolated and we are not alone.
Tsai and the others held their meeting at the Reagan Library in Simi Valley, California. The Biden administration says the detention of Wall Street reporter Evan Gershkovich is the top of their minds. Secretary of State Antony Blinken said he's spoken with his Russian counterpart Sergei Lavrov, but with no action yet. He says the State Department may formally designate the journalist as being wrongfully detained.
In my own mind, there's no doubt that he's being wrongfully detained by Russia, which is exactly what I said to Foreign Minister Lavrov when I spoke to him over the weekend and insisted that Evan be released immediately.
Blinken says they're going through the formal process and Gershkovich has filed an appeal for his release with the Russian government. Army investigators are hoping the black boxes from last week's crash of 2 Black Hawk helicopters in Kentucky will help them understand what happened. All 9 soldiers on board were killed during the night training exercise. The military announced yesterday they had found the flight data recorders and had sent them off to Fort Rucker for analysis. A new study says Americans are spending less time working than they did before the pandemic. Some are spending more time on leisure activities. That's led to a shortfall of labor. The study says it's equivalent to 2.4 million employees. Global news 24 hours a day, powered by more than 2,700 journalists and analysts.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. The Dow higher. We've got the S&P, NASDAQ, both lower. 20 minutes to go ahead of the closing bell. So let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Shaw. That's right. U.S. stocks trading mixed today with the Dow currently higher by 70 points. S&P's dropped 14, while NASDAQ is lower by 150. The U.S. 10-year yield at 3.29%. Gold is up 2, with energy trading in the red, and Bitcoin is lower by 0.4%. Of the main 11 S&P sectors, leaders were utilities and healthcare. Consumer discretionary and tech were under pressure, and leaders to the upside in the Dow, J&J and UNH, while Nike, Caterpillar, and Boeing each fell 2% and led to the downside. In other news regarding J&J, they jumped 4% after agreeing to pay $8.9 billion to settle the talc lawsuits. Market access fell 13% after monthly volume figures. And in deal news, Saudi Arabia's Savvy Games to buy Scopely for $4.9 billion. Wrapping things up, FedEx gained after planning to consolidate operating companies. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. And to hear live breaking news over at your Bloomberg, type Squawk, S-Q-U-A, on your Bloomberg terminal. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, we've got just about 17 and a half minutes left in today's trading session, getting ready to wrap up on this Wednesday. Remember, it's a holiday-shortened trading week. We do get the jobs report on Friday, but financial markets here in the U.S. are going to be closed for the Good Friday holiday. Having said that, bouncing around here on the equity side, gain in the Dow just about 0.25% higher, as Charlie mentioned. Tech stocks in particular, the NASDAQ down the most on a percentage basis, but it's really a big focus on what's going on in the Treasury trade. Right now, that 2-year note, just a reminder, 378, 10-year note with a yield of 3.29. So let's get to it with our Drive to the Close guest. And with Maddie and me is Bill Davis, portfolio manager at Hennessy Funds. Bill, specifically managing the Hennessy Stance ESG Large Cap ETF. Ticker is STNC. Fund up roughly 4% year to date. Bill with us now on the phone from Boston. Bill, great to have you here on this Wednesday. Tell us a little bit about the fund. And correct me if I'm wrong, but I think you guys made the debut, was it like when we were kind of coming out of the pandemic?
Yeah, hey, Carol and Maddie. That's right. We actually launched the fund in the first quarter of 2021. So STNC is a NYSE listed, actively managed ESG large cap ETF. And we've basically got 2 years in the actual ETF itself.
And assets under management, what kind of flows have you been seeing? And I'm really curious in particular the last, let's say, 6 months or so and more recently, just to get an idea of investor sentiment.
Yeah, I would say that things have, so last year we basically, even though the market was down 18%, I think we were down 12% and change, and our flows went up by about 10%. So we've got about $45 million in the fund today. We are expecting some inflows, some actually potentially significant ones, really just based on track record and outperformance and risk management. And I think this is a market where risk management matters.
I want to talk about the fact that it is an ESG fund, and Carol has flagged this, and we've talked about it a lot. ESG funds falling out of favor a bit, garnering more and more scrutiny. The absence of consistency in ESG classification showing the hurdles investors face when trying to allocate capital, especially given these macro headwinds. But against that backdrop, MSCI has said it's planning to dramatically reduce the number of funds it gives top ratings. And I wonder how you're feeling about those changes that are going to take effect by the end of this month.
And are you feeling any impact as a result?
Yep.
Yeah, so no. Short answer, not feeling any impact. I think that ESG as a political wedge issue is largely a dead end as a sort of an investor sentiment issue. I think that there are a wide swath of investors, institutional, high net worth, ultra high net worth, mass affluent, millennial, people with $10 to invest and people with $100 million to invest who care about these issues, or they don't, right? So, I mean, I get that there's people that don't care about them, but the people that do are not being dissuaded by congressional inquiries into, ESG. We have not seen any effect whatsoever. And by the way, I actually do welcome the idea of additional scrutiny. There are too many products that are either Me Too or, just lack authenticity. And I do think a weeding out of the general landscape would be a very good idea.
Well, and part of the big problem is, every ESG fund, it's not apples to apples. There's inconsistency, to say the least, in terms of classification. So how do you, we want to get into your picks, but how do you define ESG? You're an actively managed fund, so what says ESG to you before you, that requires you then?
Yeah, no, really good point. And by the way, I will also say there are a lot of valid approaches to ESG that are very different from what we're doing. Like, I could make an argument that you could have an ESG product that invests in energy transition, right? So that's mostly investing in today's oil and gas companies trying to pick the winners and losers in the transition to a lower carbon economy. Our particular product, this product, STNC, is fossil-free, it's weapons-free, it's tobacco-free. And really then what we look to do is invest in the intersection of good ESG and good fundamentals across as much of the economy. And I should point out our market universe is the S&P 500, so we're basically U.S. large cap. But we are, we happen to be overweight industrials frequently. And so we are not afraid to invest in segments of the economy within which the transition is not only important, but there are going to be inherent risks for companies and their investors when they aren't being ambitious enough in that transition. And so we think that there's real opportunity for investors to generate alpha there.
So talk to us some names here and what your KPIs are for those stock picks.
So we have 24 KPIs. I'm going to start by saying that.
Key performance indicators for everybody.
Yes,
Go ahead.
thank you. Key performance indicators. Sometimes we call them material risk factors because I think really what we're trying to do is on an industry group basis identify those material risk factors and then weight them according to importance. So like a practical example of that is automotive products. We get asked pretty frequently about Tesla. And, we try not to let personal feelings, get involved in decision making. And what I will tell you is Tesla is very good at certain things like low carbon or carbon transition, but it happens to be very bad at a lot of the S&G stuff like governance, injuries and fatalities, human rights, worker rights, those things. In the end of the day, Tesla sometimes is in our portfolio because it happens to be in the top 50% of its industry group, largely as a result of what it's good at and as a result of the weighting of what it's good at. And that's essentially how the KPIs work for us. And some are E, and some are S, and some are G.
Unfortunately, we only have about 40 seconds left here. Pick your name. MasterCard, we know you like. You've also recently taken positions in GE and Alphabet. You can pick one and just tell us why. And again, only about 35, 40 seconds.
Yeah, well, I'll take GE as an example. I mentioned sectors that we like. We tend to like industrials. We tend to like healthcare. We happen to be overweight in financials for the first time, but GE is kind of an interesting name because it plays in both industrials and to a certain extent healthcare. It's a strong ESG name, and there is a very strong signal right now around news sentiment, which is not typically a big signal for us, but fundamentally we like it as well, and we think it's a good time doing it.
Yeah, if you're thinking about catalysts. I mean, shares of GE, by the way, they're up about 43, almost 44% so far here in 2023. Great conversation. Bill Davis, thank you. Come back soon. Portfolio manager at Hennessy Funds, joining Maddie and me on the phone from Boston. You are listening and watching Bloomberg Radio, and this is Bloomberg Business Week.
Connection lost.
Your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got shares of Western Alliance Bancorp down now by 11.3%. But Western Alliance has paired earlier declines after saying deposits fell 11% in the first quarter to $47.6 billion. That was a smaller drop than some analysts had expected. Shares of Western Alliance have plunged by as much as 19% again. Right now, they are down by 11.2%. Apple looking beyond China in a bid to remake its supply chains. Apple is laying the foundation to make phones and components elsewhere. Bloomberg's Ed Ludlow has been following the story.
What we found at the end of last year, when there was a second serious nationwide wave of COVID, is that they were massively exposed, particularly in Zhengzhou, right, where Foxconn, the principal contractor for Apple, manufactures the higher-end Pro iPhone handsets. For Apple, it's about being able to de-risk, but also, you know, there's the political angle. We've just reported that Tim Cook has spent the weekend in China recently meeting with the commerce chief.
And today, Apple shares are trading lower by 1.1%. Fox Corp does not plan to make Rupert Murdoch available to testify at the trial of a $1.6 billion defamation lawsuit over Fox News' airing of false claims that a voting machine company rigged the 2020 presidential election against Donald Trump. Shares of Fox Corp, they're down now by 0.6%. Those are the company stories we're following this hour. I'm Charlie Pellet, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
Hi, everybody. You know, Tim is on leave.
Carol Masser, along with Madison Mills of Bloomberg Quick Take here in our Interactive Brokers studio, streaming on Bloomberg Originals and on YouTube. And in just about 4.5 minutes, we're going to head over to our TV colleagues, get ready to wrap up this trading day. We've talked about low volume. Charlie broke down the numbers, but we'll get into it in just a moment with them. In the meantime, also among our most read stories on the Bloomberg, I love talking real estate. And apparently so do Bloomberg users, because they are reading this story big time. Hamptons home price is falling for the first time since 2019. Time to buy a home in the Hamptons.
I mean, if you were waiting, now is the time, folks. If you were just sitting on a cool $1 million, you can
a few million.
A few million. Buyers in the Hamptons taking a pause. The median home sale price in the luxury space in the Hamptons fell 7.6% in the first quarter. That was the first decline since 2019. Total number of homes sold, this is a big one, slumped 44% from the prior year to a measly 424 homes.
Which makes me wonder, like, is it because there was an inventory? But the one thing I will say as a caveat, like, we know during the pandemic, so many people didn't have to work. Obviously, they didn't go to the office.
Yeah.
And people were moving out to places outside New York City proper, if you will, or Manhattan proper. And so there was a lot of buying in the Hamptons where people kind of camped out and picked up homes, and some of them who are continuing to work there. But I will say that among these data points, this is coming from Town and Country Real Estate, fewer homes sold at all price points, but the high end of the market hit particularly hard. Number of home sales price between 10 million and 19.99. Let's just round it up to 20 million, tumbled 61%. Maybe that has to do with the bonus season on Wall Street. Not so great.
That's a really good point, Carol. I also wonder, too, if you look at just the travel space as well. We did a story on Quick Take about like a huge spa opening up in the Hamptons last summer. It's not just the real estate space. It's people just flocking to the Hamptons, even just as travelers.
Yeah,
right?
and now it's exactly, and cheaper to do so.
Yeah.
And it's interesting, some commentary in this story that's on the Bloomberg also talks about, with interest rate hikes going up, I guess that maybe certainly even played into this, that maybe slowed down some of the purchases. So, alas, if you're looking for a home in the Hamptons, it's kind of on sale.
Yeah,
kind of.
Get it while you can.
All right, speaking of getting it while you can, we're going to get an update on the market close. We've just got about 2.5 minutes left in the trading session. Maddie and I are going to head over to Romaine and Katie. That's because our Beyond the Bell simulcast starts right now.
Us full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld. We're counting you down to the closing bell. Here to help take us beyond the bell. It's a global simulcast with our friends Carol Masser and Madison Mills. Welcome to our audiences across Bloomberg Television, Radio Originals, and those folks streaming on YouTube. Carol Masser, we are red across the board, but we should point out we're well off the lows of the day.
Yeah.
It looked like it was going to be a lot worse, but still some jitters out there about economic and macro conditions.
You know how sometimes we call this like a meh day? Like this is what it kind of feels like as we, it's low volume. You guys were talking about it. What?
And we should just point out, too, we're headed into a holiday, Passover starting, and of course,
Exactly.
Easter this weekend, a holiday shortened week for a lot of folks.
And it impacts things. And then we do get that Friday jobs report. Having said that, I'm looking at the semiconductor space because we are seeing some pressure there, down about 1.8%. Almost all names in that group, Maddie, are down on the day.
Yeah, but then you also look at the 2-year yield. Again, I can't stop thinking about it, giving us back 40 basis points over the last 4 days and at its lowest level since September of last year. I keep making this joke over and over again. I would not want to be a bond trader right now just because I don't know what I would do, Katie.
I mean, if you're a bull, you're having a great time, but you got to wonder about the signal coming from that. Is this
But
just
do you trust
the
it,
result
right?
of the squeeze or something? I don't know. But in any case, to your point, Maddie, wild moves in the bond market.
Yeah, and also keep an eye on the bank stocks here. It's kind of been interesting to see some of the moves there. A lot of focus, of course, was on Western Alliance and the disclosure or lack thereof last night and the update on that. But most bank stocks, pretty much across the board, are lower here. And it's not just the regional banks. Some of the big money center banks also under pressure here on the day as people are worried about the potential for a recession. Coming off that ADP jobs payrolls report this morning showing a weakness in private payroll growth. And, of course, that ISM services number that really disappointed to the downside, though still in expansion territory. the bells here in New York. The clapping continues, and, well, you get a little bit of a bright spot with the Dow Jones Industrial Average, higher by roughly 80 points as we wait for these numbers to settle. That's going to be good for a gain of about 0.2%. Meanwhile, the S&P 500 going to look close lower for a second straight day, down 10 points or 0.2%. The Nasdaq down for a third day, down more than 100 points or about 1%. And the Russell 2000, which was down well more than 1% on the day, looks like it paired some of those losses into the close, lower on the day by roughly about 1% even.
All right, so let's break it down a little bit more. If you look at the S&P 500, we've talked about low volume. We know the index is down, as Romain mentioned. But, Katie, if you look at it, almost an even split, about 223 names to the upside in the S&P 500, 277, so a little bit more of a negative sentiment to the downside, 3 unchanged in the trade.
Well, you can see that even split if you look at the industry groups. We have some green bars, we have some red bars. Let's start with the green bars. Very defensive. Utilities, they've been leading all day. That group up about 2.5% or so. And then you look down the list, you have healthcare, you have some pharma names. Again, very defensive. You also have energy in the mix as well. It's been an interesting week for energy. Of course, we came into the week with that OPEC Plus news, energy getting a bid today. Then you look at the bottom, you have autos down there, you have chips. So there you go, Carol.
Red bars, green bars, chocolate bars. That's what I really would like right now. All right, let's talk about some of the individual gainers. There's a few here. FedEx, we've talked about it throughout the day. We just talked with our own team about it in terms of what's happening. The company planning to cut about $4 billion in costs. They're combining their two main delivery networks, basically taking a page from the playbook of UPS. It's a big plan by the new CEO, looking to shore up profit margins, which have lagged by a big time what happens over at UPS. So shares of FedEx at their high, up 4%, with a gain, though, by the close of about 1.5%. First Citizens Bank shares, check it out, up more than 4% in today's trade, rallying. UBS raising its recommendation to buy from sell, lifting the target on the stock to the highest among analysts. Data compiled by Bloomberg. And of course, this is following the bank's acquisition of Silicon Valley Bank. So again, up 4% for Citizens. And then Walmart, Romain, you mentioned it earlier, up on, they had an investment community presentation earlier today. Company talked specifically about doubling its international profit in about 5 years, talking about $200 billion in international gross merchandise value in 3 years. Some analysts weighing in. They also like what the company is doing in terms of automation. So Walmart shares up about 1.7%, Maddie.
Well, I got to talk about Western Alliance. Romain, you were talking about this earlier, pairing some of those losses now after they did disclose information about those deposits that they initially left out, the disclosure easing concerns about a statement from the company on Tuesday that did not update those deposit figures. Deposit balances have increased this month, cutting this year's decline to about 9%. Western Alliance saying the bank experienced elevated net deposit outflows surrounding the announcements of SVB and, of course, Signature Bank. But interesting to pair this information with what we heard from Loretta Mester earlier today about the importance of the Fed evaluating how much credit tightening we are seeing from banks across the U.S. I also want to talk about C3AI because Carol and I are going to be talking with the CEO in a couple minutes here, extending losses a little over 15% today. Tech in general struggling today. We've got Tesla down about 3.6% as we're seeing outflows for the first time in 6 weeks on the tech side of things. The drop in U.S. yields failing to add flows through to the tech sector.
Well, let's talk about the drop in U.S. yields here because this has been a pretty remarkable rally that we've been seeing in the Treasury space. 4 straight days for the two-year yield down about 3 basis points on the day. But I want you to take a look at the 10-year yield now. You're on a 6-day rally. That means buying in the 10-year yield. That's pushed yields down pretty significantly, including 4 basis points today. We're now at 3.2. We're just going to round it up to about 3.3 right now here on the day. This is actually the biggest rally that we've seen on the 10-year Treasury yield going back to early 2020, if you can believe it here. So it gives you a sense here of the pivot that we're starting to see by more and more folks in the market. We talk about risk on, risk off. This was decidedly a risk off day.
And you're seeing that across markets too, that risk off bent. But I mean, the Treasury market is fascinating to me right now. I mean, we've been hearing for months about stressed liquidity conditions. That came into very sharp focus over the past month. And now you're just seeing, like Romain just walked through, this incredible rally. I will say the bond market is open on Friday, believe it or not. So we're going to have a chance to see the reaction to those jobs numbers in real time. Can't imagine liquidity will be too great there either.
No, but that's a good point, right? That we could get some reaction and certainly some key metrics, obviously, when it comes to whether or not we see wage pressure. So we'll see what kind of reaction. But that Treasury trade really telling us a very significant story about what investors expect from the Fed Fed and what happens in the economy later this year.
But to your point, Carol, it's going to be really interesting to look not just at the jobs numbers we get this week, but specifically in the impact and the information we get from those jobs numbers related to services, because we know that that is the key area to watch for the Fed, and that's going to be critical in terms of sussing out what the terminal rate is going to be.
It's interesting, though. I mean, we were speaking with Anna Wong of Bloomberg Economics, yesterday, and she was kind of raising this issue of just how noisy the data has been. And I saw that Bloomberg Economics updated that recession probability model, basically saying that they're now seeing a 97% chance of a recession starting as soon as July. Now, they've always sort of had a model saying a 100% chance for the year, but the idea that they're moving up the timeline for the probability, I think is interesting. And she said that that's almost directly tied to the deterioration in corporate margins and corporate profitability, not necessarily in some of the labor market and other things that we've been paying attention to.
And of course, we'll get a read on all of that when we do finally get to the latest generation of earnings season, even though earnings season never
stops.
It never ends. It never ends. But
Katie, you love earnings
we're
season.
going to do this dance again in a couple of weeks. But I was just thinking, I mean, a lot has to go wrong between now and July. We're already in April.
The good thing, though, I will say about heading into this earnings season, the number of pre-announcements that you've gotten has been pretty remarkable. And obviously that rattles the market, but it also means that, in theory, that means there's going to be fewer surprises, or at least you would hope there wouldn't be as many surprises, since so many companies have already come out with pre-announcements.
I just think about what companies are doing. We still get companies doing some deals, but we do get companies like a FedEx, new CEO thinking about, okay, what's the smarter structure? How do I take cost out of the equation? So I do think we get a lot of announcements along that front. We'll see whether we get more.
I know you've paid attention to that company a lot, and I thought it was interesting because we know
UPS in particular.
Well, yeah, right. Well, let's talk about that, because Fred Smith, of course, was really against this idea of combining those units, something that, of course, UPS has that singular structure, and that's one reason why a lot of analysts had favored that company versus FedEx for so long.
Well, and what's interesting, we were talking with our reporter on the story, and, in particular, you have FedEx, they're not the same models. And we have to remember that UPS, all of its workers are UPS workers. FedEx has used, third parties, but they've also, our reporter telling us that, there'd be cases where you'd go to a location and you'd have, maybe 2 FedEx entities. Like, that's not efficient.
No.
And so they've got to figure out that model and make it smarter. Right. And they have a lot in the air, too, and that's a bigger cost part to their equation.
In the air.
That's part of the issue with the profit margins, right?
Okay.
The planes.
Sorry, I'm keeping up.
Yeah.
Don't worry.
English is my second language, apparently.
Did you guys know that Carol moonlit as a UPS employee?
I did a day as a UPS.
What?
I did a day as a UPS delivery person. I mean, they're fascinating.
You're kidding me.
No.
Did you break down and cry when it was all over?
No.
Too many packages.
I wore the brown uniform.
Oh, she killed it.
But they're so data-centric. They track everything. I'm trying to be serious. But they're so data-centric. They track everything. Even when they drive, they make right turns so that, they're not sitting at stoplights. And I think FedEx is trying to be more like that model.
Right turn. Those are right turns only.
Well, you know what I mean?
We're gonna have to think about.
I mean, at some point they have to turn left, right? Or there's this like this is like auto racing where you just.
Faith is gonna say "rap to save me." I know she is. She's gonna say.
It's efficiency.
It's efficiency. Listen, they're different models. Important story. All right, more to come at some point. All right, that's a wrap, guys. On this Wednesday.
Are you here tomorrow?
I am. Are you here tomorrow?
No.
Aw, maybe I won't be. Okay, that's a wrap for this Wednesday. Our cross-platform coverage, radio, TV, YouTube, and, of course, Bloomberg Originals. I will be back. We don't know what's going to happen with Romaine tomorrow. Catch us tomorrow at 4 p.m. Along with Maddie Mills, live in our Bloomberg Interactive Broker Studio. As you know, we are on multiple platforms, YouTube and Bloomberg Originals. Hey, so one thing we wanted to get into now that the market has closed, it's what's going on with a company that used to be publicly traded. It's not anymore. It's Twitter, but it certainly is in the headlines a lot thanks to its now owner, of course, Elon Musk. So let's get to it with Bloomberg News media reporter Jerry Smith. There's a lot going on with blue checks and also how Twitter is classifying different organizations. Jerry, you've got a story out. First of all, let's start with NPR and Twitter. What's going on?
So Twitter has labeled NPR as a U.S. state-affiliated media. And this is really the latest escalation of tensions between Elon Musk and some news outlets that he does not like. This label is actually a big deal, and it appears on NPR's Twitter profile and on its tweets. And it means that NPR's Twitter posts won't be recommended by the platform or amplified by Twitter. And NPR has put out a statement. Its president has said that they're disturbed by this designation and find it unacceptable. This is really an unusual situation. This is something that Twitter has labeled as state-affiliated media RT, which is Russia's state-backed international broadcaster. But it had made exceptions in the past for NPR and the BBC because those organizations have editorial independence from the government. And now apparently Twitter has changed its policy.
The state-affiliated media recognition there, that's NPR puts it very plainly in their coverage of this issue. They say that is completely untrue. Can you walk us through that exact definition and to what extent it may or may not apply to NPR?
Sure. So Twitter has defined state-affiliated media as a news outlet where the government exercises control over editorial content through financial resources or direct or indirect political pressure. So NPR it's worth noting that NPR gets a very small amount of its revenue from the government. Less than 1% on average of its annual operating budget comes from grants from the Corporation for Public Broadcasting and federal agencies. The vast majority of NPR's revenue comes from corporate sponsorships and fees paid by its member organizations.
So I love the headline on the story. So Twitter putting NPR in the same camp as Russian media. I mean, that's basically it, right? Apples to apples, at least in Twitter's perspective, Jerry.
That's right. I mean, and this is really Elon Musk, since he's taken over Twitter, has really seemed to relish at poking at news organizations that he does not agree with. We've seen journalists who've been banned from Twitter. And just a couple days ago, the New York Times main Twitter account had its blue check mark removed because the news organization had refused to pay for a blue check mark. And this is something that everyone was expecting would happen, but so far the New York Times is one of the few outlets that actually had its blue check mark removed. And Elon Musk has obviously not approved of everything the New York Times has written about him. So there's really a lot of tension here between Elon Musk and some news organizations, and he is now using his platform as the owner of Twitter to exact revenge on some of these news outlets.
Jerry, I wonder if you can just talk to me about the big picture here for journalists and for news outlets like an NPR. What have your sources told you about whether or not they're just thinking, okay, fine, we're going to get off Twitter. We'll lean into TikTok where we get a higher return on views from a key demographic?
Yeah, I think it's pretty early, but I don't think we're seeing any news organizations that are removing themselves from Twitter. I think Twitter is
or pulling back resources, even if that's a lighter way of looking at it, right? Like maybe we don't need a whole team dedicated to Twitter content now.
Yeah, I mean, I think that TikTok is certainly an emerging source of audience for publishers, and so they're leaning into that. I think Twitter is still a place where news organizations, especially individual journalists who have distinct brands, are willing to walk away from Twitter. There's really no replacement for that. LinkedIn, Facebook, there's nothing quite like Twitter in terms of if you're a journalist and you want to, get attention. So I think that despite all the tensions that journalists are feeling right now from Elon Musk, we aren't really seeing anybody who's just not investing in Twitter as much. In fact, a lot of news organizations and entertainment companies are still advertising, spending money advertising on Twitter to try and get their tweets, higher up in the newsfeed.
So help me out with the blue check marks. I checked. I've got mine. Maddie's got hers. You've got yours. And I have to say, when I got it, I was like, I remember people coming to me and like, oh, you've got a blue check. Like, it really is like this silly little status thing. But it also talks to you're verified, because I had somebody actually create a fake account under my name. So it, can be a little freaky. What's the end game? Is Twitter just looking, Jerry, for another revenue stream here? Is that ultimately what it's all about? Because, without, I feel like journalists, it may not be the impactful social media site that it is. So I feel like, Elon needs media to be a part of it. So it doesn't want to alienate them completely. But is it just about a revenue stream here?
Right. I mean, that's the balance here. Obviously, Twitter is trying to generate more revenue by charging $8 a month for what's called a Twitter Blue subscription, where you could get a blue check mark. But a lot of news organizations have come out and said they refuse to pay to get a blue check mark. And that if you can pay to get one, then it sort of defeats the purpose of the blue check mark in the first place, which was to, for the average Twitter user, you could tell, all right, this is somebody who is delivering reliable information. And suddenly, if you can get a blue check mark, anybody can get one. You can no longer tell who is a reliable source on Twitter.
Well, right now, I tweeted about this because now I feel like I look embarrassing that I do have the check mark, because I don't want people to think that I'm trying so hard to get attention that I would pay $8 a month for the blue check, right? I wonder to what extent you're hearing of any journalists who are maybe confused about the blue check mark delineation, who has been able to hold on to it and who hasn't, because we have some incredible journalists here who have lost their blue check for reasons that I don't necessarily understand.
Yeah, I think there's a lot of confusion. We all expected last weekend that the blue check mark would go away unless people were willing to start paying for it. And it's now Wednesday, and a lot of people still have their check mark. So nobody, and I don't think Twitter has really given a full explanation as to what's going on and what the timeline is. So some people have them and are not paying for them, and it's just very, like a lot of the decisions that Elon Musk has made since he's taken over Twitter, there's a fair amount of confusion.
Yeah, that's for sure. But thanks for making some sense of it for us all. Jerry Smith, thank you. Media reporter at Bloomberg News, on the phone in New York City. Check him out on Twitter at Jerry F. Smith. In the meantime, some headlines crossing about Costco March total comp sales. They're coming out with some of their results. Down 1.1%. March U.S. comp sales, take out gas and FX, a gain of 0.9%. So 0.9%. Let me just do a quick check on what the stock is doing. In the after hours, it's down 1.7%, so on the move here. Tesla also out with some headlines, providing holders with a proxy access right. Board adopting some amendments to the bylaws, giving holders more rights to nominate directors. You're listening and watching Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg. Mixed to finish here on Wednesday with the S&P down 10 points today. That was a drop of 0.25%. The Dow up 80 points, higher by 0.2%, while NASDAQ dropped 129 points, down by 1%. Wall Street shunning risk today as recession talk ramps up. We had the 10-year yielding 3.30%. The 2-year, 3.79%. Stocks fell, bonds climbed after weaker than estimated economic data revived fears that a recession could be in store. Spot gold higher, little changed, up 21 cents to $20.20 the ounce, while West Texas Intermediate crude was down 0.5%, $80.34 a barrel on WTI. Again, recapping, the Dow higher today. The Dow was up 0.2%. S&P 500 index heading the other direction. S&P today down by 0.25%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar, along with Madison Mills. We're live in our Bloomberg Interactive Brokers studio, streaming on YouTube and Bloomberg Originals. Just want to remind everybody those headlines that just crossed, Charlie covering a lot of it as well. But Costco, we're seeing that stock down in the aftermarket, down about 2.6%, Maddie, as we speak. And this company just coming up, updating some of its sales number. Costco March total comp sales down 1.1%. So obviously some investor disappointment over those numbers, particularly. Costco is such a big, important indicator of what's going on with consumers and the overall economy. It certainly plays to a higher end consumer, we often point out. Stock was up prior to this news, up about 9% so far in 2023. But again, we're seeing some selling here in the aftermarket.
Yeah, and also important to note this Tesla headline crossing as well. News that Tesla will give holders more rights to nominate directors. Tesla amended its bylaws to provide proxy access, right, allowing holders meeting some requirements to nominate those directors. Let's see what Tesla is doing in the after hours.
It's just a little bit lower here in the aftermarket, so little changed here, but this is no surprise. I mean, we've had Ross Gerber on, who's a Tesla car owner. He's a big investor in the company, and you know, at one point he was certainly booking for some change there at the company. So there's been some concerns about Elon Musk, of course, the founder of Tesla, the CEO of Tesla as well, concerns that he maybe has too much on his plate. We just talked about Twitter with our Jerry Smith, right? So there's been some concerns. Tesla, I should point out, is up about 50% so far this year, but it's a big bounce off of, you know, a low.
Well, it's a big year for Tesla, of course, but we talked earlier this week about some of the struggles Tesla was having because even though they beat vehicle delivery estimates, it didn't match up with Elon's stated goals for those EV deliveries. So we have a question mark here about whether or not demand and supply are going to match up with the production and the delivery output of those EVs. So that's going to be something to monitor when we get Tesla earnings.
Absolutely, absolutely. A little bit more on what we got from Tesla, amending its bylaws, as Maddie mentioned, to provide a proxy access right, allowing holders meeting some requirements to nominate directors, so more representation essentially, to permit a holder or a group of up to 20 holders owning 3% or more of Tesla's outstanding shares continuously for at least 3 years to nominate and include in proxy materials director nominees constituting up to 20% of the board or 2 directors, whichever is greater. So anyway, so something there. And as we said, stock, though, not really moving too much here in the aftermarket. But Costco's going to be one to watch, and we'll see what impact it has on the retail sector or maybe some other consumer names in the space in terms of when the company reports earnings, because we're getting ready, earnings season just around the corner. Costco won't report until May 26th, so we've got, you know, over a month and a half, if you will, before we start to hear from that company.
Yeah, it's so interesting, though, to just hear the gravity of these numbers. This is coming from Costco's statement report on March sales results. They say for 31 weeks ending April 2nd, the company reported net sales of $137.77 billion. That's an increase of 6% from $130 billion last year. So, I mean, that's a big number, right, Carol?
Well, it's a massive company, right? You know, you're talking about a company with a $220 billion market cap company. So, yep, absolutely massive, a big player in the space. And we're looking at revenues for the 2023 year of about $243 billion. So yeah, it moves the needle certainly when it comes to the consumer space here. And so we watch what their numbers say, and there's different ways to kind of dice and slice it when it comes to, it's why you take out gas. If you look at Costco March U.S. comp sales, ex gas and FX, it's up about 0.9%. So that is something to look at as well. So we'll see. I'm looking for some commentary specifically on that Costco release, and let me see if I can get to some of it to see if they give us any indications of why specifically we're seeing some of what they're feeling some impact. We've talked about, inflation certainly making consumers have to think about where they spend their money, and some things are, you don't have a choice about paying rent, putting some food on the table, but can you go different places potentially maybe to get a better deal?
Yeah, well, and with Costco, it's really interesting to note that they take out not just the gas piece, because that's obviously a big part of Costco's profit margins there, but also the FX piece as well, because we've just seen so much volatility when it comes to currency over the past year, particularly as the Federal Reserve continues to raise those interest rates. I was just in the Middle East, where every single day I covered a different country that was having extreme volatility in their currencies. So just those headwinds, we have to remember, impact every single part of our economy, not just the macro, but also these consumer discretionary companies as well.
Absolutely. Here's a little bit more breakdown from that press release from Costco. As we said, March total comp sales down 1.1%, U.S. down 1.5%. In the last 5 weeks, Canada down 2.4%, other international a gain of about 2%. E-commerce in the past 5 weeks, we're talking about a decrease of almost 13%, down 12.7%. Wow. So yeah.
Is that because of a transition away from holiday spending, or are we past that by now? We are, right?
I don't know. That's a good question. And I don't know how much of that is still people maybe willing to go back more to stores, if you will, but we'll look for some commentary on that as well. But nonetheless, when we talk about what may be moving in tomorrow's session, Costco now down about 3.4%. So we're continuing to move deeper here in the aftermarket, so continuing to see some selling.
I wonder how the OPEC production cuts impact a company like Costco as well. We talked about this earlier this week. Right?
Yeah, I think the more persistence, right, that higher energy prices sticks around because, in terms of when things were bought and when it starts to play into the pump. So it's a good question to ask. And again, I think this is going to be one of the stories that we're going to definitely follow into the Thursday trade. Having said that, let's remind everybody how we ended up on this Wednesday. Remind you that volume has been light. It's a holiday shortened trading week, and we are seeing things kind of quiet down ahead of the long Good Friday and holiday weekend. S&P 500 on the day, just down about 0.25%, down 10 points. The NASDAQ, the most down on a percentage basis among those three major equity averages, down about 1%. Dow Jones Industrial Average, it was up about 0.25%, up 80 points. But we saw some of those traditional names like a J&J, that certainly coming to terms with the settlement, talking about the costs, right, from some of those tout cases. J&J was the top gainer in the S&P 500. It was up about 4.5% today.
Yeah, and I was talking about decliners earlier today. We had Western Alliance that was just absolutely on a drop earlier today because they did not disclose deposit information in a statement yesterday. I think given some of the market reaction today, they did end up releasing that information about deposits, but that's part of the bigger story that we've been monitoring, of course, about the fallout from the banking turmoil that we saw from SVB, from SB, from Credit Suisse, take your pick of names. Western Alliance announcing that deposit balances have increased this month, cutting this year's decline to 9%, but did say that they experienced elevated net deposit outflows surrounding the announcements of those bank issues. So that's another decliner today.
It's so important. We're in an environment where you want clarity, especially within the banks. And when you cannot disclose some of those numbers, which everybody has said these are the things we need to focus on, whether it comes to deposits and whether disclosures in terms of loan amounts and so on. These are important issues and speaks to the health of the financial community, the banking community. So that's an important one. I'm looking at the KBW Bank Index. We saw some selling, slight selling in today's session, just down about 0.5 percentage point. It was down about 2% in yesterday's trade. And if I look at the mix, in terms of the members, 22, 10 were higher, 12 were lower. So we're continuing to still see some churn there. Some of it, obviously, to concerns about Is there some more to fall, more to come when it comes to bank stress? Some of it too, I think it's safe to say that, there's more conversations about economy slowing. Are we moving to a recession? Certainly the trade, the gaps between that 10-year and the 3-month, wide margin there, and certainly seems to be pointing to a recession, and recession would mean less bank activity as well.
Right, and we were talking earlier about Bloomberg economists transitioning our estimations for a recession down from 100% chance to 97%, so still an estimation of a recession, but cooling that off a little bit. Our economists also said that they're really going to be watching the services costs on inflation to monitor what the Fed will do and how it impacts our economy.
Yeah, is the Fed making progress, or is it still really sticky, which has certainly been the story. Hey, one other point we want to mention in terms of the market trade today, we did see traders really moving into the shorter maturity treasuries. The 10-year notes yield around 1.5 percentage point below the 3-month bill rate. That is the widest margin in decades, and historically a reliable signal that the economy is headed for a slowdown. So, these are the things we're trying to parse and get an idea of what are the markets telling us versus maybe what we're hearing from the Federal Reserve. Although I do feel like Fed speak, even though they're going to continue to raise rates, it certainly has cooled down a lot in the last, 3 weeks or so.
It's like Loretta Mester said to Mike McKee today, that the Fed and the markets, they're just not going to agree.
Yeah, exactly. We'll see which one ultimately works out in the long term. All right, let's get a check on the latest world of national news. Off to Nancy Lyons we go. She is in our Bloomberg 99.1 newsroom in the nation's capital. Hey, Nance.
Thanks, Carol. Taiwan's President Tsai Ing-wen is transiting the U.S. and met earlier today with House Speaker Kevin McCarthy. She says meeting with lawmakers helps Taiwan feel less alone. Former Defense Secretary Mark Esper tells Bloomberg these kinds of talks are important.
I think it's an opportunity for her to exchange views with U.S. lawmakers about what she sees across the Taiwan Strait. And, oh, by the way, Taiwan has another presidential election coming up in less than a year, in January of next year, that will be quite consequential. So there's probably some of that being discussed as well. But I think it's important to have these meetings.
Esper says China may complain, but U.S. leaders can meet whomever they choose. Now that the charges have been released against the former president, Donald Trump, some legal minds say there are stronger cases to be made against him than falsifying business records. Bloomberg's Irv Chapman has more on the reaction.
The district attorney might have been wise to wait until federal investigators weigh in, Michael Zeldin, a former federal prosecutor, said in a Bloomberg interview. Nevertheless,
the president did all the activities that are charged in this indictment while he was a private citizen, before he was even elected president. Most people in that circumstance would be charged with this crime. Nobody would get away with that sort of business crimes in Manhattan.
Zeldin said every leading chief executive knows that cooking business records is a crime. In Washington, Irv Chapman, Bloomberg Radio.
A spokesman says former Vice President Mike Pence will not appeal a judge's order compelling him to testify in the Justice Department's investigation into efforts to overturn the results of the 2020 election. Multiple people are dead, others are injured after a tornado struck 100 miles south of St. Louis. Missouri State Highway Patrol says 5 people confirmed dead. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. The Dow higher today. S&P, NASDAQ, they both declined. S&P down 10, drop there of 0.2%. We had the Dow Jones Industrial Average up 80, higher by 0.2%. NASDAQ in the red, down 129, down 1.1%. Wall Street shunning risk as recession talk ramps up. 10-year yield 3.30%, with the 2-year 3.79%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, got it, Charlie. Thank you so much. Well, shares of AI developer C3 AI soaring about 1 month ago following a revenue forecast and comments by the CEO that were both upbeat and led to more than a handful of analysts raising price targets on the company. Last 2 trading days, though, a little bit differently, and I have seen the stock drop nearly 40%. In fact, yesterday it was the most ever in a single day after short seller Kerrisdale Capital alleged serious accounting and disclosure issues at the company. The company, meantime, put out a statement saying the short seller's letter was a highly creative and transparent attempt to diminish the stock price. So let's get to it. Joining us right now is Tom Siebel, back with us. He's the founder, chairman, and CEO of C3 AI and the firm's third largest shareholder. The stock, by the way, has almost doubled here in 2023. We must also note Kerrisdale Capital, one of nearly 30 short-selling firms being probed by the U.S. Justice Department over potential trading abuses. And the company's owner, Adrangi, saying early this year that the firm had not been contacted by any government agencies over investigations. Sam Adrangi is the head of the company, the chief investment officer. Tom Siebel, thank you so much for being here with us. What do you say to the short sellers? Well, first of all, how are you?
I'm great. Thank you. How are you?
I'm doing okay, trying to keep up with the news flow. I wish it would get a little quieter. So let's get to what the short seller is saying. They're saying that you used highly aggressive accounting to inflate your income statement metrics in order to meet sell-side analyst estimates for revenue and certain profit metrics, and to conceal a significant deterioration in your underlying operations. They put this in a letter to your auditor. What's your response to this?
Well, I think this was an enormously creative and successful effort by a notorious short seller who it's widely reported is under investigation by the Department of Justice and the SEC, okay, and has drug and alcohol convictions. And it's highly creative, highly successful to issue this screed that contains not a word of truth, okay, short the stock, publish this letter, knowing that it would move the stock. And I think yesterday this person made in excess of $100 million. So it was very creative, very successful. Attempt at what appears to be successful stock price manipulation.
So, John,
that is the story.
So, Tom, so the charges or allegations of this short seller that's saying that you guys are, presenting yourself as being in a high margin SaaS software as service businesses rather than one based on lower margin consulting. This is the letter they put on. Are you a consulting company or are you a software as a service business?
About 80 to 85% of our revenue comes from software subscriptions, and 15 to 20 comes from consulting services. This person, this short seller alleges that we report to get 99% profit margins off of our largest customer engagement, which is Baker Hughes, and there is nothing in any financial statement that will support that. It's a complete fiction. And he says because it's 99% margin, must be something wrong with it. Well, he's subtracting apples from oranges to try to come up with some sort of nefarious act. He alleges that the fact that we have unbilled receivables is very serious suspicious, and good software companies don't have unbilled receivables. And he neglects to mention, the many companies like Salesforce, Datadog, IBM, Adobe, and Alteryx, SAP, all of which have many, very large unbilled receivables. Unbilled receivables is just, something for which you recognize revenue for which you haven't submitted the invoice yet.
Right.
It's very common in the industry. It's well understood, and he's trying to imply that there's something wrong with that. There's nothing wrong with that. It's proper accounting. But the guy succeeded. I mean, sometimes crime pays. And it paid off for this person in a big way yesterday. So we have to, our hats are off to him.
So Tom, and I want to get into what you guys are doing in terms of AI, because that's initially why we asked you to come on. In terms of your accounting, Deloitte and Touche, they're the one who got the letters. You're comfortable with their accounting? You've talked with them. You're comfortable with their disclosures?
Our disclosures are correct. Our accounting is absolutely correct. We have unqualified opinion statements from our independent auditors. We have best practices in terms of accounting, in terms of audit committee practices, and that, I mean, this is just a bunch of poppycock. This is a trick that this character played on the market, and he made somewhere between $100 and $200 million at the expense of C3 shareholders yesterday. And so hats off to.
And no regulators have reached out to you, or that firm hasn't reached out to you?
They have not reached out to us, and while it's widely reported that these guys are under investigation by the SEC and the Department of Justice for stock price manipulation, we've not been approached by either of those regulatory bodies about this firm.
And have you been buying any of the shares on the downfall?
Me personally, or C3?
Both?
I have not been buying stock in the market. As you know, the stock is up about, I think, 100% year to date. Okay, and it's been,
it's almost doubled.
We've reported in our earnings announcement that business is quite good and the business climate is quite good. And my only hope is that this short seller in particular, and the short sellers out there, hold on to their stock, because they're going to get, in my opinion, they're going to get crushed.
Real quickly, and then we'll pivot to AI, I promise. How do you refute the short seller's argument that part of your success and gains is related just to the ticker name and the overall hype around AI right now?
I mean, that's just a silly statement. I mean, I think the name AI, I mean, I think there's no value probably attributed to that. The fact that we're in the AI market, I think that, a rising sea kind of lifts all boats. And so we are clearly a leader in enterprise AI. Enterprise AI looks like a $500 billion addressable market in not very many years. C3 AI is in a position to establish, if not the leading position, a leading position in that market. So there's no question that some of the upward pressure on the stock is due to the realization of the size of the addressable market opportunity that C3 faces.
And quickly here, I just wonder, as CEO, how do you not get seasick on these market moves? Because you had all of these gains, then obviously a tough couple of days here. What is your thinking around strategizing for your long-term goals despite the market volatility?
It's very easy. I ignore the market and focus on the long-term goals. Our business is to build a great company, have satisfied customers, have a cash-positive, profitable business, market leadership position. And, if we do that, we can just look. We have, I think, last quarter, something like $850 million in the bank. So we are unquestionably an ongoing concern. And I think if we focus on the big picture here, stay focused on the big picture, I think this will work very, very well for the shareholders. But we don't really look at day to day or minute to minute or even month to month. I think, as far as we're concerned, the market could close for 5 years. And but I think this is going to I think this is going to work out very well for the shareholders, the employees, and the customers in the long run. And that's my job. So the reason I don't get seasick is I don't look at it.
So, Tom, just got about 35, 40 seconds here. So, I mean, what is the big win for you guys in the next 6 months that you say, hey, listen, short sellers, you've just so got it wrong?
Oh, I think that if you're on the short side of this year, I mean, our business is good, okay? And we're in a position to, we recently transitioned to a consumption-based pricing model that's really well received by the market. We expect to see, as when the Fed gets ready to take its foot off the brakes, okay, as it relates to dealing with inflation, I think you're going to see C3 as a very rapidly growing, market-leading enterprise application software company that's profitable, cash positive. And that'll be reflected in market valuation.
Tom Siebel, thank you so much, of C3 AI. As we said, a lot of analysts upgrading this stock last month.
your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. A down day for Western Alliance Bank Corp. That stock plunged today by 12.4%. However, it did pair earlier declines after saying deposits dropped 11% in the first quarter to $47.6 billion. That was a smaller drop than some analysts had estimated. Shares have been down as much as 19%. The bank put out a statement saying it experienced elevated net deposit outflows surrounding the announcements of the Silicon Valley Bank and Signature Bank closures in mid-March. Again, today, shares of Western Alliance Bancorp down by 12.4%. New York Auto Show underway, and Bloomberg Radio caught up with Nissan Senior Vice President Jeremy Papin, who talked about the automaker's expansion of its electric vehicle offerings.
You know, Nissan's going to be launching about 27 new cars in the next 7 years, 19 of which will be full battery electric vehicles, and most of which will come to the U.S. We'll have an EV in every market that is significant to the U.S. consumer.
FedEx seeking to cut $4 billion in costs by combining its two main delivery networks in an ambitious plan by the new CEO Raj Subramanian to increase profit margins. The company has for decades operated an express package business separately from its ground unit, which FedEx acquired in 1998, and depends on third-party contractors to make the last-mile delivery of parcels. FedEx up 1.5%, rival UPS down 0.6. Those are the company's stories we're following this hour, and this is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, everybody. Carol Master along with Maddie Mills here in our Bloomberg Interactive Brokers studio on YouTube, on Bloomberg Originals. We are kind of everywhere. Having said that, really appreciate, we were kind of tight on time, but appreciate Tom Siebel of C3 AI coming on to talk with us about the shorting, and so just interesting to have him come on. I did want to say that I mentioned something about analysts upgrading the stock. They actually, a bunch of them after earnings last month, raised their price targets on the company, so they're pretty optimistic. All right, back to World and National News we go, and Nancy Lyons. Hey, Nance.
Thanks, Carol. Donald Trump's attorney, Joe Tacopina, is sounding confident that his client will never go to trial on charges concerning alleged hush money to Stormy Daniels. He spoke on NBC's Today Show.
I think this case is going to fall on its merits, on legal challenges well before we get to a jury. If we get to a jury, I think any person, whether they're on the right or politically opposed to Donald Trump or in favor of him, is going to see this for what it is. It's weaponization of the legal system.
Tacopina tells NBC there was nothing new in yesterday's indictment, despite what the district attorney said. DA Alvin Bragg says he brought the charges against Trump after receiving additional evidence in the case. Well, there's been a shakeup at Wisconsin Supreme Court. Bloomberg's Amy Morris reports on election results from yesterday.
Wisconsin voters chose liberal Judge Janet Protasewicz over conservative former Judge Daniel Kelly.
You have entrusted me with great responsibility, and I will treat the role with the highest degree of integrity.
For the first time in 15 years, the Wisconsin court has a liberal majority as it takes on issues like abortion and voting rights. Protasewicz was elected to a 10-year term, and this Supreme Court election was the most expensive in U.S. history, with more than $40 million funneled into the race. Amy Morris, Bloomberg Radio.
Chicago has a new mayor. Progressive candidate Brandon Johnson beat out fellow Democrat Paul Vallis in elections yesterday. Johnson, a former teacher and union organizer, had the backing of the Chicago Teachers Union. He was out thanking supporters early today.
Seeing people out this early in the morning during spring break, it just shows you that the city of Chicago is ready for the type of transformation that has been missing for a long time.
Johnson and Vallis both beat out incumbent Lori Lightfoot, who became the first incumbent to lose in the primary in more than 40 years. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Carolyn Madison.
All right, Nancy, thank you so much, as always. Nancy Lyons, she's there in our 99.1 newsroom with World and National News in D.C. Hey, Carol Messer, Maddie Mills. We just talked with C3 AI, Tom Siebel. Really appreciated addressing directly the short seller that has really dragged down the stock in the last couple of days. It's on a tear this year, but making some very serious claims. So we appreciate Tom joining us. Having said that, I do feel like the world is just all agog when it comes to artificial intelligence, specifically generative AI.